changing environment, but also to changing risk-taking by banks. I don't know if transparency will either make them more or less sclerotic, but for sure, that's one of the things that we need to worry about. So if the public puts a stronger eye on those models, if it helps to mitigate against this risk of them becoming static, stasis, and sclerotic, I think that would be a very good thing. They are, to your point, one of the sources of volatility in the stress capital buffer. The other two are changes in scenarios, which you mentioned, but there's one more, and that's a change in bank portfolios and the business mix that banks have. I think the latter two actually are the biggest drivers. I don't think that changes in models or so-called imperfections of models, recognizing that all of these models are going to be imperfect, are really the biggest drivers. It's the changes in scenarios and the changes in portfolios. So that leaves us with a question then, okay, what do we do about this volatility? On the one hand, the volatility might just reflect the realities of life, that the risks are changing. And that's one of the real strengths of stress testing. It dynamically evolves to adapt to those risks. But it also makes, as was clear in some of the earlier discussion today, it makes capital planning really hard, and I have a lot of sympathy for that. So then we come to like, well, what do you do? One of the proposals that has come out is to average across 2 years. You've got one scenario, you've got a number. This year, you have a number last year, you take the average of the two. I would candidly rather than average one scenario across 2 years, I'd rather average 2 or 3 scenarios in any given year in this year to really capture a much broader sort of scope of risks. Now, you know, for those of you who have been doing stress testing for a living at banks, you know this is an enormous burden to actually crank the machine, write down all the documentation, do all the review and challenge. And the burden has really sort of gotten, frankly, out of hand. So I would, in that sense, like to see a reduction in that documentation burden, that governance burden, and then perhaps in exchange, we can get more than one scenario in any given year and take the average of those rather than just one scenario over 2 years.
Thanks a lot, Till. That's great. So, Kate, what would you choose? More transparency, averaging, revised assumptions, or something else? And sort of to the extent you can, why or why not?
Yeah, I mean, I think building directly off of Till, I would separate out the two different issues. I think averaging is meant to deal with a number of challenges. To the extent the challenge is the model is broken, we should fix the model. We shouldn't use averaging to try to correct an error of the model. That being said, as has already come up much today, it is more challenging for banks to try to figure out capital planning when there is significant volatility from year to year. You want scenarios to be different. You want to be testing for different things from year to year. And so you don't want, in an effort to make sure we don't have too much volatility, you're actually shying away, and I think we've seen this, from testing out different types of risks. And so in that sense, I think averaging can serve a very positive purpose apart from the model. In terms of transparency, I think a lot of the question is, transparency to what end? And is it helping to support the rigor and the efficacy of the test, or is it potentially undermining it? You know, I happened to get like an email from Gallup this morning, and one of the first headlines was like, trust in institutions is just at an all-time low in the United States, right? So like banks, it's between 20-something and 30-something%, depending on who you're looking at. But basically, if you look from like the 1970s to today, you have this very clear downward secular trend in terms of trust in institutions. And I think a lot of government rightfully thinks about, well, we're going to build up trust by promoting transparency, and I think there is a greater burden on the government to be transparent and have that be a mechanism through which you promote accountability. But I think ultimately the way that you build up trust is you do your job and you do your job well. So I think the key question here is this going to help enhance or undermine the efficacy? The best thing we know historically, I was walking with Scott Frame on the way in here, and he did a tremendous paper back when I think he was still at the Fed, looking at OFAO. So, I mean, stress tests started for the banks in 2009 with Till and others with this great effort. Fannie and Freddie were earlier to it. OFAO was earlier to it. They realized stress testing is going to be incredibly useful. And they said, look, we want full transparency. We want to make sure that the model is robust. So we're going to go through this notice to comment process and come up with a really robust model. They came up with, it seemed like a really robust model. But then partly because they'd gone through this notice and comment process, it was really, really difficult for them to update or change that model. So again, it became overly static over time. And when it became overly static, you ended up with a situation where they failed miserably. OFAO no longer exists, and it no longer should exist. So I don't think that's like the right direction to go. So I think when we're thinking about like what are the mechanisms of engagement, there's a lot of really smart people in this room who are also incredibly knowledgeable, others watching online, figuring out whether it's a conference or other settings, how can we promote frank dialogue and learning. I think it's a really important end. But I think you want to be really mindful of, are you doing this in a way that continues to enable dynamism and learning? I think one of the themes that came out of this morning's conversation is that oftentimes where there's problems, things are overly static and they're not changing. So we want to make sure we're not doing it in a way that introduces unnecessary or counterproductive rigidity into the system.
So John, you obviously advise and sort of analyze U.S. investors. What do U.S. investors think of the Fed's current approach? Would they prefer more transparency, averaging, something else? And how valuable do you think averaging actually would be for investors?
Yeah, so I think investors share many of the concerns expressed already and would be supportive of these proposals, even if they're not perfect. If you think about investor concerns, the first is the over-reliance on a single scenario. That's definitely a concern. Also, the investors feel the scenarios have become a bit stale and at times focused on yesterday's risks. In some ways, it feels like we keep replaying the great financial crisis over and over on a loop each year with the test. So some dynamism and new scenarios would be welcome, of course. And the biggest issue investors have is unexplained volatility. It's not just volatility, it's unexplained volatility. When we look at the results, we can look at two banks that look quite similar in risk profile and end up with very different SEB results in the same year. If you look at the same bank over time, we can see big swings in an individual bank's SEB and hence their minimum requirement, sometimes 100 basis points or more, even when there's no visible change in that bank's risk profile that is detectable to the market. Sometimes there's no change that's detectable to the bank itself. So that unexplained volatility has hurt credibility of the stress test process in the eyes of the market. So as a result, investors are strongly pro-transparency on the simple view that sunlight is the best disinfectant. Get the models out for public scrutiny, put the scenarios out for comment so there can be a public debate about what risks are being tested and which business activities are getting a thumb on the scale in the stress test process each year. In terms of averaging, I think, again, it's not perfect, but averaging does dilute the reliance on one scenario, and it does give investors and banks a bit more of a glide path to adapt to changes in their capital requirements. And it's not just investors that need that. There's a whole host of constituents that banks have, employees, customers, communities, and shareholders that are vested in and dependent on their capital allocation decisions. So giving a glide path and some predictability is helpful. So averaging can help with that by providing some smoothing benefit and reducing the over-reliance on the scenarios.
Thanks a lot. So one of the things we're going to do when we get to the Q&A session part of this, we're actually going to, as long as they're not too long and wordy, we'll actually have people comment. Like I'd invite people to say, what do you think? Are there any other insights on how to sort of address the flaws in the models that we've been using? Are there other ways in which we can do that or address volatility? The next issue we're going to talk about is Pillar 1 versus Pillar 2. Now, most of you in this room, very sophisticated, probably know what the difference is. But as I said at the outset, Pillar 1 is the minimum capital requirements. The SCB, you know, when the way we do with our stress testing, it creates a Pillar 1 minimum capital requirement. I'm going to ask the next question to Nat here to my left because the Bank of England does it, you know, very differently. And actually, he'll have to explain what Pillar 2A is because I probably can't do it justice. But they use sort of a Pillar 2A approach. And in any event, rather than having a supervisory annual stress test, they have a test every other year. And I understand that the Bank of England considers both its supervisory assessment of the impact of the stress test and the UK bank's own assessment of that impact in determining the buffer requirement in addition to the fixed capital conservation buffer of 2.5%. So it's more of a discretionary add-on to the CCB. And so if you could just tell us about your approach and maybe contrasted to the US, that would be great, and sort of why you've chosen that as opposed to the approach that we've chosen.
Yeah, no, thanks, Randy, and thanks very much for having me. So as you say, no, I should have pressed that. As you say, we updated our approach to stress testing the banks at the back end of last year. And if we take a step back, we do feel in the UK our stress testing approach to date had served us well. I mean, as Till and you and others have said, they were a big part of how we managed to stem the crisis in 2009. And on the back of the crisis, one of the mission number one for financial stability was to strengthen the banks, and our stress tests were instrumental in achieving that. So we feel it served us really well, but in recent years we started to use them in a different way. To deal with several things that had changed in the system. And so we felt it was right to take stock and to refresh how we're doing it. And our objectives were twofold. First, we wanted to ensure we did it in a way that reflected how the financial system had evolved over time. And the other thing we wanted to do is to ensure the burden on firm was proportionate to support their competitiveness. So we did three things. First, we moved to running a full-blown bank capital stress test every 2 years instead of every year. And the only reason why we felt comfortable doing that is because banks were strong enough that we felt we could get the answers we needed by doing this full-blown stress tests every 2 years. And we've got one going on this year at the moment. And the quid pro quo for all that is that it does free up a lot of resources at the banks, which can then be used to invest in their own risk management. The other thing we are doing is that in the intervening years, when we're not doing a full bank stress test that sets capital, we are still keeping an eye on the resilience of the banks, but in different ways, in ways that are less resource intensive for the banks. And the other thing we are doing, because of that capacity that is created, is pivoting towards doing more and more exploratory scenarios, which don't lead to any capital answer, but which helps us and the participants in the stress test be better prepared for shocks. So that's what we are doing and how we are evolving our approach to stress testing the banks. Now, we are indeed doing one at the moment, a full-blown bank capital stress test. And that does inform the capital requirements for banks. And so in terms of the question about how it works, as you say, we use firms' own estimates of the impact of the scenario as the starting point. And we have our own models, our own estimate of the impact of that same shocks. And we use that to kick the tires, to challenge the estimates of the firms. That's the approach we have been using for a long time, and that's the one we're continuing to use. We do that for several reasons. First, it gives us multiple analytical perspectives on the answer, and it helps us triangulate what the impact is of that scenario. We do it because the reality is that we would struggle to guess accurately the behavioral responses of the banks to some of the scenarios of each individual banks. We also think there is, for the UK, there's merit in using the same models that banks use to inform their own risk management and their own capital planning, because it's important that banks get that right too. And this also enables us to benchmark firms and their own modeling capabilities. So, for example, if you've got two identical or very similar asset portfolios in the same scenario and different banks come up with different answers, then obviously we can kick the tires. And if one bank has a lesson to learn in terms of its own stress testing methodology, we can have that conversation. And finally, I mean, we have to be honest that our own modeling capability isn't perfect, and we would struggle to capture the full riskiness of banks' activities. And that's why when we do a desk-based stress test, which is only us, only our models, we don't publish individual firm estimates of that, only aggregate estimates. Having said that, in aggregate, our own models have proved reasonably good at anticipating the total impact of shocks on the banking sector as a whole. So, usually when we then get the answers from the firms, it's pretty close in terms of sector-wide level. So that's that in terms of which models we rely on. Now, in terms of the link with capital, we don't really think about it in terms of Pillar 1 versus Pillar 2. So then that's where I come to this Pillar 2A thing. Instead, we think about it in terms of minimum requirements versus usable buffers. And for us, minimum requirements is Pillar 1 and Pillar 2A. And Pillar 2A is very simple in the UK, is the risks that we know are not included in Pillar 1, like, for example, interest rate in the banking book, which we discussed this morning, and which is very relevant these days. So those are known risks that are not included in Pillar 1, and we have published methodologies for how to calculate Pillar 2A estimates for those risks that are missing. And often those methodologies rely on stress scenarios, and that applies to all the banks in the UK. So that's for the minima. On the buffers, the usable buffers, we're including that the capital conservation buffer, the countercyclical buffer, and the firm-specific supervisory buffer, which we call the PRA buffer after the prudential regulation arm of the Bank of England, which is firm-specific. And and the way it works really comes back to how do things play out, how do we want things to play out when a stress actually happens. When a stress actually happens, we want firms to stay above their minima, to stay alive, to stay operational, but also we want them to continue to lend to the economy. And as what we typically do in those circumstances is that we release the buffers, as we have done recently. So what we want is firms to be able to stay above their minima, having used all of their buffers in order to lend to the real economy. So that's what we want to happen in reality. So in terms of what that means for our stress test, we assess how much capital a firm needs to stay above its minima, having run its buffers, and we deduct the conservation buffer and the countercyclical buffer from that impact, and the residual is what feeds into the firm-specific buffer. So we avoid the double count via that means. But there are other things that feed into the buffer. It's not mechanistic, and it's very much firm-specific. So the impact of the stress test is one thing. Another thing can be, in the case of some firms, risk management and governance, because typically firms who are less good at it also tend to be more prone to losses. So that's a conversation that supervisors have with the firms, and as and when they improve, well, that gets removed, that bit of the buffer. And finally, there may also be other risks that the firms themselves have identified which warrant some extra bit in the buffer. So there's several things that feed into the PRA buffer, and it's much broader than just the output of the stress test, and it's an integral part of the supervisory dialogue with the firm.
Thanks a lot. That was fantastic. So I think one of the themes that has come up in bank supervision over the last few years is to actually encourage boards of directors to provide credible challenge to management, and for various people in the organization this is actually credible. We're inviting credible challenge to our stress testing process and how we do it by talking to by listening to sort of how the UK does it. Bank of England always has interesting ideas. But let me turn to John. We're actually going to dive a little bit deeper in this from the U.S. perspective in terms of responding to what Nat said. And so, John, if you could just tell us how you think U.S. banks or U.S. investors, would they prefer the Bank of England's discretionary approach, not sort of obviously 2A and 2, is it 2A and 2B, or sort of constrained discretionary, but ultimately discretionary, over the Federal Reserve's Pillar 1 approach? And then sort of a related question is, should the Federal Reserve decouple its supervisory stress test from the Pillar 1 capital requirement, and why or why not?
Thanks, Randy. So I think from the perspective of U.S. investors and U.S. banks, they would first readily acknowledge the merits of the approach that Nat described and consider how we can incorporate some of those benefits. I think at the end of the day, there's an overriding concern that pushes most of the U.S. banks and many investors to the side of keeping stress testing as the driver of Pillar 1 requirements. And I think the main concern is that moving off of that, moving to a fixed CCB system could have the effect of empowering and perhaps pressuring supervisors back to adjusting capital requirements in Pillar 2. What we've seen over the last decade is that a lot of supervisory activity happens behind closed doors without disclosure, transparency, or accountability. Keeping public stress tests as the driver of Pillar 1 capital requirements does hold the supervisory system accountable. And both banks and investors want capital minimums to be driven by a process, not by people or politics. So, I think you could imagine in a fixed CCB world, there would still be Dodd-Frank mandated stress tests. It's not hard to imagine a scenario where a few banks do poorly on the stress tests and supervisors might feel pressure to do something, and they might require those banks to run with more capital. In that scenario, we've kind of backdoored our way back into an SCB process anyway, except it'd be done kind of behind closed doors. So I think the argument is to keep it public and keep it transparent the way it is now. And the background story here, and Randy Quarles touched on this with his breakfast analogy, is that both banks and investors have a lot of emotional scar tissue around the evolution of the stress test. There were years of worrying if a foot fault in their models or a bad relationship with the supervisor or not filling out their work correctly could lead to a quantitative fail or a qualitative fail. So I think that fear of moving back to a Pillar 2 system has most banks voting against decoupling. One other concern around decoupling is that we could risk losing some public faith in the system and the process if markets and the public don't see some consequences to the stress tests and some modest explainable variability year to year in the SCB results, both across banks and across time.
Okay, so the next one, digging down a little bit, is for Till, since he was one of the designers of the SCAP, and has had many years, being one of the leading experts on stress testing to sort of give us his perspective. So, if you had three different choices, so blend the supervisory and company-run models the way the Bank of England does. That's one option. The other is to rely exclusively on the bank-run models for certain projections, with the Fed supervisory models acting as a backstop for the projections. Or incorporate each firm's projections and data into the Fed's supervisory model. Any thoughts on the pros and cons of any of those, and which one, if any of them, or some other one, would you favor?
So the U.S. stress testing regime is unusual in putting all of its stress testing capital eggs into the supervisory model basket, if I stretch that metaphor a little bit. So it puts really a lot of pressure on those models to perform reasonably well. And in that way, the U.S. regime is more exposed to model risk, really, than other regimes are. What's more common is what Nat described, which is to blend the supervisory model output and the company-run output. I talked earlier about imperfect models and model risk, and one way actually, and a really good way to mitigate against model risk, is to average not just across scenarios or across years, but actually to average across models. So I think the idea of averaging across both the supervisory and the company-run models to arrive at a final result, I think is an idea that's worth very much exploring. Now, it's not obvious that you would, to me anyway, that you'd want to weight one more than the other. At least in peacetime, it's not obvious to me that you would want to do that. You mentioned, I think you meant PPNR. PPNR is sort of, which is pre-provision net revenue. That's notoriously difficult to model for anyone. There's in this model averaging and using of company-run models, one of the concerns is that, well, the banks are going to undershoot losses. On average, that's true. We know that from the disclosures that bank loss projections tend to be lower than Fed loss projections, but company-run PPNR projections tend to very often be higher than, lower also, than Fed projections. So it's not clear that systematically across everything that the company-run projections are going to push the SCB down, probably a bit, but the averaging will mitigate against that. The concentration, however, in one set of models is probably across all things what makes me most nervous. It makes me more nervous than the idea of having company-run model results push the SCB down further than it would otherwise. Now, all of that is in peacetime. I think in a crisis, I would err towards putting most, if not all, of the weight on the supervisory models rather than have a blend of the two. But in peacetime, a blend, I think, is the better way to go.
Okay, Kate, I'd love to have your views, particularly on whether the Fed should decouple stress testing from Pillar 1, capital requirements, and how do you deal with the lack of comparability? One of the problems with going to a more discretionary test is that it's less comparable firm to firm. So if you could address those issues and kind of which of the various alternatives that we've talked about or the Fed's current position, you can always vote in favor of the current process as well, but in any event, it'd be useful to have your thoughts on that.
Yeah, no, I mean, it's a great issue, and it is an important issue to discuss, just because, again, the U.S. is an outlier. So whenever the U.S. is an outlier, you want to figure out, like, why are we doing this differently? I do think at times it's also important to understand, like, the history of the SCB. Randy Quarles gave an incredibly articulate and thoughtful explanation this morning, and it was implemented, of course, on his watch. But it was initially proposed by Dan Tarullo. So it's important to realize this isn't something that has a clear partisan bent one way or another. A lot of it is the rigor of the test, not kind of like where you situated. And so there's room for flexibility across these two different issues. I mean, I think part of the question for Pillar 1 or Pillar 2, and I think the characterization of 2A is really a beautiful way to do it, or it could be like 1B, is like, it is inherently something that's in between these two, right? So if we think about it historically, it was used in SCAP very significantly, where you needed to recapitalize. It was a tool of recapitalizing the banks. So we needed information to figure out how to recapitalize them that made the assumptions underlying the stress test actually credible, because we were already in a distressed environment, and you wanted to stop the ongoing fire sales and pressure that was happening. Whereas when you're in peacetime, you're actually thinking very hypothetical, you're thinking in forward-looking ways. It's just a completely different exercise. And again, part of the reason it also got paired with capital so tightly is it's an important counterbalance to what we know is like the biggest drawback of capital measures, which is they're backward-looking. They're incredibly backward-looking. And so the idea is we wanted something like forward-looking to balance it out. So there's reasons those two came together. But that doesn't resolve the Pillar 1 or Pillar 2, as I think the Bank of England example nicely brings out. I mean, the other thing that the Bank of England example nicely brings out is, I like the recharacterization, not as Pillar 1 or Pillar 2, but is this something that you actually want banks to be able to use when times get tough? Because we, in terms of looking at the financial system, need banks to be able to provide credit when times are tough. Or is this instead something that is a sign of strength, and we also need people to have faith in the banking system during periods of stress? And so how do we balance these two? And that goes back to, like, when we got the SCB, the capital conservation buffer and the SCB are doing very different things. And so we kind of think about the history like, okay, well, these things are compatible, but I think Nat's breakdown shows that they are not compatible at all. Like, the SCB is saying, like, look, this is how much banks need to endure the stress that they're currently facing. That's not something you want to tell banks that they can use during periods of stress. The capital conservation buffer, like the CCYB, is instead saying, look, the banking system plays a really important role during periods of stress, trying to provide credit to the real economy, and we need them to be able to play that. So I think there's like a bigger kind of conceptual issue that we need to think through and be honest about. Is this something that we want to make usable, or is it not? Right now, with the SCB, it's not going to be usable. The last thing I would note just briefly on this are questions around legal risk and how much concerns about legal risk might be driving some of these changes. I think the Fed's brief actually was a remarkable brief explaining why the current regime works potentially as it does, but I do think if perceptions of legal risk as opposed to optimal policy are driving changes, then there's reasons to think, well, maybe we need to restructure where we put this in the overall framework so we can back to think about like what's optimal policy for the health of the banking system and the broader economy, and not let kind of like indirect concerns about legal risk undermine or deviate too much from what would otherwise be optimal policy.
So I'm going to ask one more question, actually, to John, then we're going to open it up to the audience to ask questions. And that is, so how much capital do the banks actually have in practice? In other words, what drives bank capital levels other than the stress testing or the minimum capital requirements? And is there a difference between the GSIBs and the non-GSIB LBOs? I'll say, large banking organizations. So what role does the market play in deciding sort of what the capital is that banks actually operate with?
Yeah, so if we think about the everyday kind of capital targets that banks run at, for the GSIBs, the stress test results, the SCB actually does drive changes in where they're targeting to run. For a whole host of other banks, the actual day-to-day stress test results don't drive where they're running at. So for example, you have super regional banks that have CET1 ratios today and targets in the 10 to 11% camp, even though their minimums are 7. So they've got 300 or 400 basis points more than their capital minimums. And there's a few reasons for that. First of all, the reported ratio for capital for regional banks don't include AOCI, and it does for the GSIB. So in a period where banks are still carrying sizable unrealized losses on their balance sheets, the regional banks will have to hold more capital just to be kind of on par or close on an AOCI-loaded basis. And second, beyond regulatory rules, markets and other constituents also impose capital requirements on public companies. So in the case of banks, you have fixed income markets, equity markets, and rating agencies, all of whom are kind of requiring regional banks to run above their capital minimums in that 10% ballpark today. And that's kind of why they're still there today. And even in a post-CIV-B world, even without market pressures, banks often worry that the Twitterverse or other social media forces can create the impression of problems at banks. And this is during wartime. So it's another reason regional banks probably don't want to get their capital metrics too far away from the biggest, safest, too big to fail banks. But I think it's important to keep in mind that if the cumulative changes that occur in the system allow big GSIB banks to run with less capital, we could see smaller banks run closer to their minimums. That doesn't lower the minimum requirements for regional banks, but it could lower the buffers that they run with.
Okay, thanks. So I think we actually have time for one more question before I open it up. So I'm going to ask Kate. I was going to say we didn't have time to talk about exploratory scenarios, but I think we do. So anyway, Kate, can you tell us in your mind what the view of what the value of exploratory scenarios are? And then Nat, you talked a little bit about exploratory scenarios. I have to say I'm completely intrigued by the one thing in the paper about reverse stress testing. I know that's one of the things you did during COVID, but I'd like to sort of hear both of you talk about exploratory scenarios and the values, or the pros and cons. Maybe there's some cons to them as well.
Yeah, I mean, I think they've been actually an incredibly important addition to the tool set. I mean, precisely as we've already discussed, whether you're talking about Pillar 1 or Pillar 2, when you're running a stress test in a way that it's going to feed directly into a bank's capital requirement, odds are you're going to hedge a little bit the types of questions that you're going to ask because you don't want to have extreme volatility from one year to the next with respect to the capital you're asking banks to hold, to use to fund their activities. That being said, like the value of the stress test is to keep banks on their toes, regulators on their toes, and to like develop information, not just on a bank-by-bank basis, but also on a system-wide basis. Like how would various types of shocks, because we know there's all kinds of different shocks that can hit the economy, how would different types of shocks actually affect like different parts of the banking system, and also how effective are the banks at understanding how those different types of shocks would affect their profitability and other aspects of their activities. I mean, they were formally introduced as part of the stress testing structure in 2023. I think that, again, was a really important introduction. But I would also say, when we discussed earlier, that during 2020, the Fed ran, they said, 7 different stress tests. And I think that was incredibly useful. And I would consider that a kind of a form of exploratory stress test. Once a crisis actually hits, even if it's in early stages, you're no longer engaging in hypotheticals. You're trying to figure out, okay, here's something that's just on the precipice, but potentially could get worse. And you're making decisions over whether or not to allow banks to continue to pay out dividends. I mean, having real-time information that's going to be imperfect and dependent on highly flawed models, but still meaningful, closer to real-time information, I think is incredibly useful. And so I think having that be part of the overall tool set that you're using on a regular basis makes you far more prepared to adapt. And then just finally, I mean, we had this like great conversation at lunch. I mean, there's just like such a possibility of different types of disruptive changes. And I think you can ask, like whether something's growing really quickly, whether profitability is really quickly, you can really ask about things that are like on the margins as tail risks, but potentially could be disruptive in different types of ways. And I think it's a great exercise to continue to undertake.
Okay,
Great. I very much agree with what Catherine said, and one of the key reasons why we're using exploratory scenarios more and more is that the financial system has changed a lot, and with that, the roles of the banks within it. So we want to point our stress testing toolkit towards answering a much broader set of questions than whether a given bank has enough capital or not. Because although that still is a fundamental necessary condition of financial stability, it's more and more becoming an insufficient condition for that financial stability because of how different the financial system is now. For example, with the prominence, as we discussed yesterday, the greater prominence of non-banks and market-based finance playing a much bigger role in the provision of vital services to the real economy. Banks are still very much involved, notably by being by far the main providers of leverage to non-banks, either in core markets, sovereign debt markets, for example, to hedge funds, or in private finance market like private equity or private credit. So banks are still very much involved, but in a very different way to what their involvement was in the past. So we sort of felt we had to pivot our toolkit to make sure that we and the industry understand what these type of new paradigms mean for financial stability and for growth ultimately. And specifically, so we did last year a new kind of stress test, which was our system-wide exploratory scenario. We love talking about it, so I'll be very brief about that. Where we basically stress testing an entire market, an entire ecosystem, and core UK markets, so the gilt market, the gilt repo market, and associated derivatives, with many participants beyond bank, including hedge funds, asset managers, etc. And to understand first how resilient the markets would be to the shock, and second, how the behaviors of the participants could amplify that initial shocks, and what that meant for how those participants should adjust their playbooks so that if one of those shocks does happen in the future, they're better prepared for it. So the answer is not more capital, more liquidity, it's just being better prepared when those shocks happen. And some of those shocks have happened, even very recently. So it is very helpful, and the benefit of that, we saw some of that in the recent turbulence. So those system-wide exercises have a bright future in our mind in the UK. But even just for banks, and coming back to exploratory scenarios, just for banks, for the banking sector, these have been very helpful. And for example, when the pandemic hit, we ran a desk-based stress test on the scenario that our monetary policy committee had published, an illustrative scenario about how the stress could evolve through and propagate through the economy. And we wanted to know something very simple, which is, well, how would the banking sector react to that shock, to that scenario? So we did it, we ran it, desk-based, and we got the answer that they could withstand the shock and continue to support the economy in those conditions. A few months later, in August, we ran a reverse stress test because we wanted to know, the scenario had started to unfold, and we wanted to know how bad it would have to get for banks to start to be constrained in how much lending they could do to the real economy. What would it take for banks to run down their buffers? We talked about the usable buffers. The reverse stress test told us that. And both of those things meant that we could say, when we ran those tests, we could say to banks and in our public communications during that period in the start of the pandemic, that we expected banks to continue to lend to the economy. That was one of our big messages at the time, because they were strong enough to do it, and because there was one of the key roles they had to fulfill in those circumstances. That was one of the uses of those exploratory scenario. Last year, we ran another desk-based stress test of the banks at a time where there was great global uncertainty. And it was very difficult to anticipate where things would go. You can still say the same now. And we ran it, we talked about running multiple scenarios before. Well, that's what we did. We ran two scenarios, a supply shocks and a demand shocks, one with interest rates going up, the other one, interest rates going down. So we did not have to guess which one was the most relevant or the most plausible. We ran both using our desk-based toolkit. And that was very helpful thing to do. And it informed indeed what type of scenario we are using this year for our full-blown bank capital stress test, for example. So those are the type of things which don't necessarily lead to capital, but they help us answer a much broader set of questions and help the markets more generally being better prepared. So let me pause here. I mean, all these things are in our mind, they have a great future. And we feel that's an important way, an important direction towards which to point our toolkit. But what's for sure is that that's here to come, and especially is as memories from the global financial crisis are fading, because yet stresses do keep happening.
Thanks a lot. So we're going to open up for questions. I'm going to hope that the CFO panel will actually address one thing we don't have time, which is we can see the benefits. We've certainly talked about the benefits of exploratory scenarios, but what are the costs to the banks if we're doing exploratory scenarios? Yeah, so I think we've got a question here in the front. Sharon.
Hi, Sharon from Morgan Stanley. Till, I had a question directly about something you said that I didn't fully understand. So I actually agree. I think there's a great benefit to using some of the bank's own models within, working with the Fed to help them understand both where we come from an industry perspective, changes. I think a lot of the bank models right now are done on an industry level, particularly when you think about expenses, for example. And that, I think, does create a lot of challenges with the underlying results that you end up seeing from a stress test. But you said something where you agree with that in peacetime, but then in periods of stress, you would use the bank's models. Now, as we know and we saw in COVID, you have periods of stress that are pretty immediate. How would you move to the Fed models so quickly, and how would you make sure that you're holding enough capital? I didn't quite follow how that would work.
Right, so just to be clear, I think in a crisis, I would err towards using just the supervisory models, or mostly the supervisory
models. But how
models.
would you go back? I mean, I guess
right,
how
so
would you flex?
Right, so a key question there is, and this is always whenever you have these discussions of peacetime versus wartime as well, when do you know that you're in wartime? Yeah, so I'm going to punt on the question of when do you know when you're in wartime, because it's an admittedly very difficult thing to decide. But you could also make that gradual, so that if you're not quite sure, but you think that it's on the horizon or it's on the threshold, or you might in fact be in it, then this blending approach will allow you to shift gradually more and more weight towards the supervisory model if you're not quite sure. And if then there comes a point where you're quite sure, in late 2008, we were pretty sure we were in one.
I was just more thinking of COVID, right? You one day woke up and there was a global pandemic. You weren't really that sure. It took 2 weeks and all of a sudden we were all at home. So it was a little...
Right, but 2 weeks is pretty fast.
Yes, yeah. That's my... Okay. Thank you.
Back there in the middle, in the back. Yep.
Hi, Luigi DiGenghi from Davis Polk, a.k.a. one of Randy's former partners. This is a question really almost more, it's directed to the panel, but more directed to Mr. Benjamin in particular, which is, if you're going to try to create a balance between reliance on bank models and supervisory models, how do you strike that balance? Or to put it another way, will you do it based on a particular percentage variance between the results of the models? So you say, okay, I'm going to rely on banks' models up until they vary up to a certain percentage from the supervisory results, then I'll question them. Or is it based on supervisory feedback and discretion, which obviously is less transparent?
Yeah. So just to be clear, our starting point is to use the models that banks, so the estimates that banks submit to us. Typically what we see is that in the aggregate, basically both type of approaches agree and point to the same answer. We've never really had any issue on that front. Where there's more variation is firm by firm, bank by bank. So when there is a variation between what our models say and what the bank's models say, we ask why. And we have that conversation bilaterally, privately with the bank. And sometimes there's a good reason for it. maybe better risk capture or something else. And sometimes there isn't. And in that case, then that leads to an adjustment. But it's a conversation, a private conversation we have with the firm. One example, for example, and we talked about the difficulties of modeling net interest income, which you called PPNR, I think, here, is what assumptions do you make about pass-through of the rates that are paid on deposits, for example? And you can have different firms making very different assumptions, and because we see what everyone submits, we can say that, in a world where there's competition for deposits, not everyone can be right at the same time. So that's an example of an adjustment we would make to a firm's estimate. So that's how we've been running it for a long time now.
Got one back here, and then Daryl Duffy. Sorry. Yeah.
Looking at me. I was just going to pile on the PPNR issue. I think the notion of going back and forth between bank models and Fed models doesn't work no matter how you weigh them unless we get the Fed models right. I think you'll find universal agreement amongst the banks that the PPNR approach that the Fed takes, it's one of the reasons we've all screamed, is just wrong. So I want to be really careful about some assumption that, hey, we can use ours sometime and then just jump back to a bad model. The whole exercise on having transparency with the Fed models is to hopefully be able to, put eyes on whatever is causing the variance that we see every year when we do this. Severe enough, just as an aside, our firm, for example, right, we always try to solve an outcome worse than whatever the Fed's going to come up with, and the only way we can ever do that is just bin a giant operational loss into our results because we don't have any idea what the Fed model's doing. The second point I would make that I do think is really important, and I think the UK gets this right, is some risk measure stress around interest rate risk in the banking book. We have no measurement today in the US that looks at this, and we need to. And then the final thing I would just remind everybody, to me, the stress test, we do multiple stress tests continuously. The stress test shouldn't just be about a pretty bad thing that we can all survive. It should actually it should be about the thing none of us can survive. When you run a risk book, you always figure out, that's what you do all day long, is what's the thing that can get me fired? What's the thing that blows me up? And there's always something, right? There's always a weakness in the system. And so in the scenario design, not that I want to publish and scare everybody, but I would actually spend time in the scenario design and the what if, these alternative scenarios, to what is the worst case that we can come up with. And you can, I can come up with a lot that would scare, scare the heck out of us. I won't plan to that scenario, but it's good to know what that is.
Could you just pass the microphone over to your right, and then if we have time, then Daryl Duffy next. Yeah, no, right there, yes,
Yeah,
you, and then
quick question. Scenarios, models, exploratory scenarios, there's a lot of potential cost here, and I think you were going to raise this issue. My question is whether this activity, stress testing or process, lends itself to efficiency gains, perhaps substantial resource cost reductions via artificial intelligence.
Okay, so anybody want to answer that? Was there a question? No, okay. Daryl, do you want to ask?
Sam
the
Altman has
last
left the
question,
room.
sorry. Okay.
Great. There's been quite a bit on the costs and benefits of multiple scenarios, among which you already mentioned volatility of capital requirements on the one hand. Several of you mentioned benefits of getting more information about different types of stresses, but none of you have discussed it. I noticed the extent to which a bank may have an incentive, if there's only one scenario, to adjust its business model and its balance sheet towards that one scenario. Is that a significant risk, especially when the tests are quite transparent? Or do you have the opportunity to change that one scenario often enough that banks would not have time to all tune themselves to that one scenario with the attendant risks?
Okay, John, then Till. Yeah.
Go ahead, Till. I know there's six, there are 6 bank CFOs coming up next who'd probably really answer that question well.
Yeah, so I do think there is a risk of this. I think the risk is not so much that you do it from one year to the next. I think the risk is more that for some, I mean, really, if you look at the DFAST program since almost its inception, the shape of those scenarios has not changed much at all. Many of the sort of core variables, core stress factors, the basic shape has changed, like literally almost not at all for GDP and unemployment and house price indices and so on. So over time, you're kind of teaching the industry to just focus on these tests, these scenarios. Everything is just pegged to this one scenario. So over time, it's very natural for banks to respond in kind, because keep in mind that all a stress test is a very, very bespoke risk weighting algorithm. It's not really anything different. And so if we think that banks will respond, you know, either desirably or undesirably to a particular risk-based capital regime with particular risk weights, we shouldn't be surprised that also they will respond, you know, similarly if the same scenario, more or less, over and over and over is presented to the banks, and they'll shift their business model.
Okay, go ahead.
If I may. So, I mean, I agree with the sentiment behind your question, Darrell, about the merits of being able to run several scenarios. That's why last year we did that with our desk-based capability. So this was not a full-blown capital stress test, you know, setting capital requirements, requiring submissions from firms, but we use our own models, our own technology to do that, and we got a lot out of it. And that's then linked to the next stress test, which did set capital. So that's a bit of a halfway house to get to your point. In terms of efficiency, I very much agree with the point on efficiency. But the fact of moving to every second year instead of every year on a full-blown capital stress test, you know, does mean a considerable reduction in burden and in resources spent on those capital stress tests. And the capacity that gets freed up by that, we very much expect that will be used by banks to improve their own risk management for that. But there has been a big reduction as a result of that.
Okay, thanks a lot to our panel. Very interesting. Thank you very much.
day. My name's Adam Gilbert, partner at PwC. I'd like to thank Vice Chair Bowman for putting on this very important conference and inviting me to moderate and pulling together this outstanding panel. Let me introduce them quickly. Daryl Bible to my left, M&T Bank, Alistair Borthwick from B of A, Raul Nalgokar from BMO, John Stern from US Bank, Mike Verdeschi from Charles Schwab, and our anchor, Sharon Yeshaya from Morgan Stanley. So thank you to all of you for joining us and for this terrific panel. It's fitting that we close the day with perspectives from CFOs. The CFOs play such an important role in the capital process at banks. In fact, they own or manage with their teams the capital calculation, the allocation of capital in the bank, the capital action planning process, the communication with investors about those capital actions, and importantly for this forum, play a leading role in policy discussions. So it's really appropriate that we conclude the day with perspectives from the CFOs. So I'd like to start by asking for your perspectives on why reforms to the capital framework are so important at this time. Does the current framework cause you to make suboptimal or inefficient decisions? Are there competitive issues that are especially problematic because of the framework? For example, have the capital requirements played a role in pushing assets outside of the regulated banking system? We've heard about that, some of that today. So Mike, would you kindly lead us off on this framework setting question?
Yes, thank you, Adam. And again, on behalf of the panel, thank you, Vice Chair Bowman and the broader Federal Reserve. Important set of discussions today centered around ensuring safety and soundness, while at the same time ensuring the banking system can support growth in a range of environments. Taking a step back, so much of what is the capital regime today was born out of the experience and the crisis of 2008. Since then, the capital regime has evolved, but so has capabilities at firms and a broad range of capabilities managing across risk stripes. And that is a really important element to think about, certainly as they connect. Stepping back, yes, this is the right time for that holistic review. And really, we heard much of this today. 3 themes I would highlight. Think about that holistic view in terms of where are the best practices that resulted in the capital regime that we have today. Where within the capital regime do we have redundancy and therefore inefficiency? And then lastly, what parts of the capital regime have unintended consequences? And to unpack that a bit, some of those best practices we just heard from the stress testing conversation, those internal stress tests have been developing over time. And the banking system have gotten much better at them in terms of identifying emerging risks in the face of an evolving macro environment and understanding whether you have the capability to manage those risks in a range of environments. And importantly, tailored to one's business model and tailored to one's business strategy. So I think I continue to emphasize the use of internal stress tests, whether that's a complement, whether that's the primary. It's really important that internal stress tests are utilized. In terms of redundancy and inefficiency, again, we heard about the different elements of the framework, leverage, evolving risk-weighted assets, and then importantly, stressing risk-weighted assets. And do we have more capital through those mechanisms than what's needed? And does that in any way get in the way of providing that capital to the broader economy as needed? Importantly, as well, in the inefficiency, as we see environments unfold like we did in 2023, there were different elements that caused problems of certain banks, and that was the connectivity of liquidity and how that interacted with interest rate risk. It's important that capital is relied on for the solution of all things. It's important as those environments unfold and there are certain vulnerabilities to ensure that the framework entails making sure you have the capabilities to manage those risk stripes and not just rely on capital. And so there, sound balance sheet management ensures that you can identify risk, measure various risks, and ensure you have the capabilities to manage those risks in a range of outcomes. That's capital, that's liquidity, but that's also interest rate risk as well. And then just briefly touching on unintended consequences. There's really two elements here I would highlight. One is how leverage can become a binding constraint in times of stress. And we heard it this morning as well. If the Federal Reserve needs to embark on quantitative easing, that liquidity will come into the system. It will make its way onto the balance sheets of financial institutions in the form of deposits. Taking a deposit from a customer is the most basic financial service that we can provide. Simply taking that deposit and leaving it at the Fed account, that would draw capital. Another aspect is if you're taking in deposits in times of stress, does that increase in liquidity necessitate more liquidity in the form of long-term debt and some of the rules that may be unfolding there as well? And then lastly, sound liquidity management. It's always good to have, it's always essential to have enough liquidity on hand before you hit a stress. But even in periods of stress, it's prudent, sound liquidity management for maybe the Treasury community to build a little more liquidity at that time. But building liquidity, again, would be leverage and therefore tying up that liquidity in the form of capital. So it's important to understand the interactions across those risk stripes. And then lastly, we just touched on this as well, unintended consequences. Has the capital regime become costly? Has it become cumbersome to the point where that credit origination is happening outside of the banking system, outside where it's regulated today? And is that a framework that we want going forward? And will that capital origination really be available through the cycle? So with that, I'll take a pause there and allow other members to make comments too.
Others comment?
Yep. First, I just would like to thank Governor Bowman and all the other Fed officials for putting this on. This is a very unique and I think very helpful meeting that you've gathered together. So I really appreciate that. Just to add on to what Michael said is the framework for developing capital requirements should be transparent and appropriately align capital with risk. When capital requirements for asset classes are significantly greater than the underlying risk, lending migrates from banks to non-banks and can allocate to a more appropriate capital level. We see that today in the mortgage market. If you look at the supervisory test, there are numerous examples over the years where the charge-off rates, the capital charges that we got, were much higher than what our models came up with. You could see that in the most recent stress tests with the new category, MBFIs, where they're basically charging a rate now of 7%. If you really look at what the category, what's in that bucket, there's some high-risk lending in there, and there's some really low-risk lending. You got capital call lines, low risk. You got mortgage warehouse, low risk. But you also have high risk in NAV lending. So it's really important that those loss rates that you put in there are really important. The best example is M&T in 2020 got a super high CRE charge rate, such that it was in double digits, mid-teens, and we basically went on a path now for 5 years where we basically shrunk our CRE portfolio. And it was forced by that stress test because the capital charge was too high. You know, we're now down half of what we were 5 years ago and now starting to grow back. But what you put in here, we respond to and we make decisions off of that. And it's really important that we have the best facts. When we talk about models later on, getting the models right and knowing what the losses are is what's really critical so we don't make poor decisions and have to leave things off our balance sheet. When we look at the Basel III Endgame proposal, should consider putting appropriate risk weights in those categories. Recently, senior regulators suggested and review of some SR letters, the impact of leverage lending guidance is shifting from banks to non-banks. That should be examined. And then finally, the FRB's publication of Reg Q that was in September of 23, where all banks from 5 billion up to the G-SIFIs are utilizing credit risk transfers. I think it might be helpful and be transparent how we can basically handle this in the Basel Endgame as well as in our stress testing processes, and actually come out with how to handle that stuff. Oh, that's it.
That's great, thank you. Any others? Sharon, you want to?
I was waiting for my next question.
Your next one.
I might just add
Yeah, John.
really quickly, because I agree with Mike and Daryl on how they allocated that. I think the other thing that, just to tie it together, when we have these decisions on capital, you know, whether it's in the stress test or whether it's in proposals from Basel III Endgame, there are risk weight considerations that when we allocate capital to business lines and have to make pricing decisions and things like that, it can really impact how we go to market, how it impacts clients, how it impacts our conversations with clients. That's really meaningful. And so, you know, when Basel III Endgame came out as an example, you know, there was a surcharge on mortgage. We had to decide, do we need to upprice all mortgages? And it's already a very competitive market with banks and non-banks alike. So that's just an example. There's others associated with it. But just to tie it together from a client's perspective, we have to answer those questions as well.
That practitioner perspective is so helpful, so thank you very much. So when we were preparing for our panel, many of you felt that any reform should take into consideration the interactions or the interplay of the various components of the capital framework. So Sharon, can you elaborate on this point?
Yes, I'd love to. First of all, thank you for having me. I felt very strongly about this question. First, you know, I'd really break this into two pieces. One is we have leverage, and I think that the Fed and the OCC and the FDIC are doing a great job with the proposal to make leverage more of a backstop rather than a binding constraint. So let's put that aside. We've spent a lot of time talking about the building blocks of CET1 and what it means on Randy's panel. And I'd like to pull some of the points that have been made kind of together. The first question that you opened with is why now? Why is this the right time to be having this conversation? And when you started to really feel and understand the overlaps, in my mind, it came when Basel was introduced. Basel is, as we know, was intended to really relook at the underlying base RWAs that we have. And there are, when I think of the building blocks for your regulatory requirement, you have your base RWAs, then you stress those bases, and then you have buffers on top of them. The base RWAs are the questions that we've begun to face and we think about when we look at Basel, and we say, is this the right base, and should we be changing the underlying base for a regular run rate business? Now, that might be the case. You might be in a situation in which we should change the base. You know, that's a discussion to be had specifically with each of the underlying RWA proposals around Basel. However, when you begin to put that into a stress testing regime that has already existed, some of which was intended to compensate for the fact that you didn't have Basel Endgame yet implemented, that's when I think you begin to look at these potential overlaps that weren't addressed in the original NPR. And I think one of the main reasons in my mind why a form like this has become so valuable is that we begin to look at it and try and think more holistically. I often give the analogy of, it feels like, obviously we're based in New York, and it feels like an old New York City apartment that they just keep painting over and over and over again. And you're sort of like, what color was this supposed to be? And so I think that we should strip the paint, and we should take a look and say, what are we trying to achieve? And then build both base and stress, bringing them together. And if you want to put on top of that, then an additional buffer. Call it GSIB. I think that some of the points that Steve made on his last panel when we did the GSIB buffer, in terms of short-term wholesale funding, in terms of rebasing things for GDP, those are really important to keep it fresh, the same way that you want to keep stress fresh. You don't want stress to be static, because the stresses in and of themselves, as we just heard in the last panel, change. So I'd go back to sort of what are your first principles? Your first principles is to figure out how much capital do we think needs to exist within the system, And once that decision has been made that this is the kind of size of the capital, system that we have, and this is how much the banks need to hold, fine. How do we then adjust and kind of give that capital or allocate that capital appropriately to the risks that are being run on a day-to-day business? And that has to also do with the business models that the businesses have and how they've evolved. And I don't think it's about gaming the system. The banks are not we're not trying to bring ourselves down. And so I think that we need to kind of get past the last 20 years and say that there isn't an intention to fail. We are also, we have review and challenges. We're trying to make changes as we actually go through these stress tests in terms of our own institutions. And so then allocating, the question becomes, how do you allocate it appropriately?
Thanks, Sharon. Others want to jump in on this point?
Well, I guess only I should start by thanking Governor Bowman. Thank you. Thank you to the board for inviting all of us. Thank you to the panels before, because I thought they were all terrific in their individual sessions. But each of these individual rules that we all face every day is well-intended. And whether it's SLR or GSIB, whether it is the stress capital buffer, TLAC, the interest rate, risk management, they're all designed for safety. And if it's only one, if there were only one thing, then some conservative is absolutely natural. One would expect that, hope for that, etc. But actually, this idea of this connection between them really becomes important to us as practitioners, because we're managing all of them. And we're managing not to one stress test, we're managing to all of our stress tests. We're running multiple stress tests by the week, by the quarter, by the month, all the time. So in total, these rules tend to get to be more conservative because they're greater than the sum of the individual rule. That's what we're optimizing. That's the inefficiency. That's the efficiency that you can unlock to pass on to consumers, the US economy, to jobs, to loans, etc. So that's the public policy. That's the good that we're all after. And that's why we're so pleased to see a holistic review that actually takes a look at how those things intersect with one another.
That's great. Thank you.
Sure. First of all, Vice Chair Bowman, thank you for having this, and to the entire Fed staff here, this has been a great experience. I think just kind of as the panel was discussing, the three things which keep coming back in general here is the capital framework balanced? Is the capital framework holistic? Is the capital framework clear and has clarity? And I think that's where these things keep coming back, is in the balance side being, do we know the financial risk and are we balancing that with the economic growth? On the holistic side, have we, I like your analogy, I'll remember that one. Are we painting the building again and again, or are we actually looking at the root causes and associating the solutions with those root causes rather than a patchwork? And then clarity is very important. I think as practitioners, we'll all, and those of you in the audience would agree, when you're to put this into actions and the models are run, and practically you are deciding whether it's your business model, whether it's your stress testing regime or capital management, practically how do you put that? And clarity not just in terms of have you understood it, but also how will you explain it? Explain it to your investor, explain it to your board. So I think going back, those are the three things which keep coming back is it balanced? Is it holistic, that there are no downstream implications, unintended consequences, and the third being clarity?
Terrific. Thank you, Raul, for that. So I want to get into some of the specific components of the framework. But before we do, John, Darryl, and Raul, as regional banks and an FBO respectively, tailoring is a critical determinant of how you manage capital. So as Governor Bowman and the other agency principals proceed with their reform efforts, what should they be thinking about or specifically addressing with respect to tailoring? John, you want to start us off?
Yeah, I can start us off. You're right. First of all, the tailoring is a very important part of how we think about capital. I mean, obviously it impacts us in terms of how we compete with other banks. It obviously influences how we price certain sorts of asset classes and things of that variety. Specifically, when we're looking at capital allocation for different business lines and these sorts of things, it's very impactful in how we think about it. So, obviously, you have an opportunity here to take a look at things. I think the way I think about it is there's really three things principles I would think about as going through it. The first is really about simplicity. You know, Jerome talked about it and others in terms of we've had the last 15 years, we've had multiple capital regulations on top of each other. They are competing priorities that we need to address and think about as we're going through it. So the ability to simplify is obviously very important. It allows for the capital planning components to be much more streamlined from our standpoint, and it allows for maximized pricing for when we go to market. The second is really about indexing and how do we index appropriately from a threshold perspective. This is really something we've been focused on for some time. Any bank that is at 99 billion or 249 or 699 knows that there's some impact when things, from $1 to the next, you'll be in a different type of regime. And so the indexing of that is, at this point, those index thresholds are static. And obviously, we have a very dynamic macroeconomic environment that we are in. And so, therefore, from a standpoint of having that dynamic ability, we want to make sure that the index is adjusted for something like GDP or inflation or something. Otherwise, you will pull forward. Just think about 10 years from now. You're going to pull forward a number of different banks into different regimes that may or may not be appropriate, despite that sort of indexing. And that kind of gets to my last point, which is really about the cliff effect as we go forward. As you go into these sorts of things, there is that bank at 99 that is going to go to 100 the next day, and suddenly everything changes. And I think there can be an opportunity to think about smoothing, or how do we think about pre-positioning some of those regulatory activities before approaching that threshold, and then what are the things that can take time and be adjusted over time as well. Post-adjustment, so it's not the cliff effect. At the end of the day, we have a number of diverse banks, and so that's what the beauty of tailoring can do, is can adjust to all that, but those are important things that I would think about.
Yeah, I'll just add on to that, John. First, for us, and I think for many of the medium-sized and smaller banks, I think it's important tailoring actually happens and it's real, so it helps us serve our customers and communities as we serve our clients. When you look at tailoring, it's important that we align the scope with the complexity of the regulation and the risks that we're trying to solve for. Supporting thresholds for capital, liquidity requirements, and like John said, indexing for inflation, I think are really important. Consider utilizing more, maybe a macro factor, multi-factor model, elements that are a way to determine thresholds rather than just total assets. I think one of the important points is that future regulations should continue tailoring approach. For an example, when Basel Endgame was proposed, it had market risk for the smaller banks. There's really none of the smaller banks that really had any risk in that area. So we need to be really aware of what services and products they have before you try to put rules in place that we have to do that don't make a lot of sense. And it's also important that tailoring applies to supervision. And when we say supervision, we don't want to be treated as one of the larger banks, such that we want to follow the rules that are really important, like credit risk, interest rate risk, liquidity risk, operational, cyber. Those are the real key risks that you really need to do to make sure you run a really sound company. But other things around supervision, I think, are more for the larger guys than for more medium and smaller banks.
Yeah, I think for the FBO, we are more of a super regional in the US, so I guess they've already covered the things on my mind, so I won't repeat.
Okay. Let's get into some of the specific components of the framework. So, Alistair, we now have a proposal on the ESLR, TLAC, and long-term debt, and a very important question put forward on the treatment of treasuries. So what are your thoughts on the proposal?
Well, I thought the panel did a really nice job of talking about SLR and ESLR. And, again, this is one rule. It's not the only rule. It was intended as a backstop. And then there's a lot of other things that we all have to operate under. Capital, liquidity, interest rate risk, et cetera. So what was interesting about the pandemic and the lesson that came out of that for all of us was that ESLR became too binding. It became the binding constraint. And so we feel like recalibration makes sense. We're supportive of that. And it's going to help banks in 3 or 4 ways. First, it provides ample capacity to absorb liquidity in future stress. This was Tiffany's point on the panel when she said shock absorber for liquidity. That's what she's talking about. Do you want America's banks being able to take liquidity as the government is pumping in stimulus to fight a healthcare problem? Okay, so that's going to help with that. Second thing, it will help support functioning of the U.S. Treasury markets, and a couple of the panelists talked about how important that is. It's a bedrock principle for our economy, for capitalism, for America's competitiveness. It's going to help. So that's number 2. And number 3, it's in line with banks all around the world. It's now U.S. getting in line with other jurisdictions. So we're not SLR constrained right now. That's different. There are different banks that are SLR constrained, but it gives more flexibility, more capacity, and I think it was Ben who talked about that in the panel earlier, just how much it gives banks freedom, flexibility to do things. So I thought that was helpful as well. The narrow exclusion of U.S. Treasuries makes sense. It's definitely helpful. Everyone can understand intuitively why we would do that. It will give us a little more capacity. But of the two, obviously, recalibration is a lot more helpful.
So, Darrell, Mike, and Raul, does the question on treasuries trigger anything for you with respect to, the treasury question relates to broker-dealers, and does that trigger any considerations from where you sit?
I mean, for M&T and for the vast majority of smaller banks, it's really not an issue that really has any impact on us. The only thing I would say is if you're going to adjust the SLR ratio, consider adjusting maybe the Tier 1 leverage ratio as well, because we would be impacted from that perspective as well as just trying to be consistent from a leverage perspective.
I think similar to what Darrell mentioned, not a binding constraint, but if we are looking at this, I think it makes more sense not to just look at the treasuries, but as this whole concept started as leverage started as a binding constraint as a backstop, which became a binding constraint, you want to also look at the unintended consequences of all the items on treasury, whether it's cash reserves, whether it's the treasury repos, because then you are looking at this holistically end to end using your terminology. If banks are the shock absorbers for the market liquidity, what else are the products out there which you look at it end to end?
Mike.
Yes, and I would say on the Tier 1 leverage, certainly should be looked at as well. And again, it's that risk-off environment where liquidity can come into banks, and having the ability to either leave that at the central bank account, tying up capital would seem unnecessary, certainly for reserves. I think treasuries, it goes back to that broader question, what is going to inform how you hold capital against treasuries? Is it anything at all? Is it leverage? Or is it stressing those treasuries into market values and holding capital against that? So I think the treasury question is important to look at broadly.
Great. So, Alistair, we had a discussion earlier about the GSIB surcharge. So what's problematic about it, and how should it be fixed in terms of design and calibration from your perspective?
So I think, funnily enough, this is going to echo some of John's comments just a moment ago, and it will also echo the panel that we heard earlier. We have 2 big concerns with the GSIB. The first one is international jurisdictions use Method 1 only. So we all know that. The US uses Method 1 and Method 2, greater of. So when people talk about gold plating in the US, that's one of the things they're talking about. It's just a higher standard here in the United States. For most of the big banks, Method 2, the surcharge is 100 to 200 basis points higher than Method 1. So that's what you're talking about when you talk about quantifying gold plating on this one narrow point. The second issue is that Method 2 uses fixed coefficients that haven't been updated in a decade. So that's problematic for us because during the course of the past decade, a lot has changed. GDP is up 60%. The S&P is 3 times larger. The tradable float of securities is much larger. The US bond market is much larger and likely to get larger from here. So there's a lot going on. Banks are larger too, but if this is meant as an indicator of systemic importance, banks may not be any bigger as a percent of the system, actually. So the two potential solutions that the panel discussed, and I think they're both entirely valid and the ones we should consider, are first, should we eliminate method 2? That may be something to do in the context of Basel III finalization, look like the other jurisdictions around the world, remove the gold plating, and level the competitive playing field for US banks. That's one possibility. And the second is we can recalibrate method 2 for economic and financial growth. Nominal, most likely, so that you've got something that's indexed and where you're really talking about real growth, systemic growth. Are you systemically more important today than you were 10 years ago? And then you just kind of need something that's annually thereafter. The points on window dressing or cliff vesting, I mean, I think there's good ideas around that of averaging over time. Wouldn't support daily, but whatever it may be over some period of time, and narrower variations in the cliffs. Those, I think, are easily solved also.
Terrific, thanks. Let's pick up on the stress testing from the previous panel. There's a foundational question here about whether and how the stress capital buffer should be fully embedded into Pillar 1 as part of the capital stack. So my question to you is, should it be? Should there be 2 capital stacks, for example, one that includes the SCB and one that doesn't? Should the stress test be a supervisory exercise only and not formally incorporated into the capital requirements? How do you see the trade-offs? So, John, you'd like to start us off on this one, and then Sharon maybe pick up from there too.
Sure. Yeah, I can start us off. From a stress or from a capital framework perspective today, as a Category 3 bank, we are in effect a single stack firm. So we have the 4.5% minimum, and then on top is the stress capital buffer. From a simplicity standpoint, that seems to be an effective way for us, and I think that can be, whether people want to use that abroad, I think it would be helpful. I think the simplicity of these sorts of things always can be very good from, I think from a regulatory standpoint, it allows focus as well as the tools that regulators can use from a supervisory standpoint around that can be very helpful. I think if we were going to do that and have it in Pillar 1, which I would agree with, then I think you have to have tenets along with that. One would be the transparency of it. We've talked, I think, a lot about the transparency in the models and what that all looks like. I think that would be very helpful. That allows for that comparability, allows for the transparency from a regulatory as well as from a bank standpoint, and understanding how to communicate what the capital requirements are. And I think from a holistic calibration standpoint, that's the other component, is that if you have a single stack format, then making sure that the stress capital buffer, at the end of the day, it's calibrated in a way that, where we aren't 4 layers of conservatism on top of something. So I think there has to be some adjustment as relates to that. So, at the end of the day, I think about, simple, I think of effective, and I think of transparency. I think the simplicity from a single stack allows banks to capital plan better for their clients' needs. I think from a transparency standpoint, that allows investor comparability and things of that variety. And I think from an effectiveness standpoint, regulators do have tools around that from a supervisory, et cetera, to make it work. So that's kind of how we think about it.
Sharon.
Sure. If I could add to that, we talked a lot. We wrote a public comment letter, obviously, to Basel, and we talked about potentially introducing 2 stacks and thinking about Basel in a separate stack, mainly because really there was a question about overlap within the SCB if you did not actually solve for the underlying issues within CCAR. So putting that aside and saying, okay, there are some benefits to looking at a 2-stack approach. Now let's think about if that is not what we want to do and we want to embed Basel into a single stack approach. How do we do that, and can we do it within a Pillar 1 framework? I will echo some of the comments made by most of the practitioners, which is I prefer a Pillar 1 approach versus a Pillar 2 approach. And I prefer that for many reasons, particularly the fact that I think a Pillar 2 approach does it can create a lot of questions around who your supervisor is, what the supervisory guidance an individual bank may get, and where there might be certain biases that come out from a supervisory perspective. So I do think a Pillar 1 approach is better from a practitioner point of view, but also from an investor point of view, particularly within the United States. So that's kind of step one. Now, if we're going to keep going with what is the benefit of Pillar 1, is I agree, there's better capital planning, particularly with an SCB. And why do I say that is, I think that what Randy Quarles did very, very well was moving us to a place where we had an ability to begin to plan, right? We had more planning capabilities than we had historically. Maybe we still have some planning challenges because the results in some of the CCAR tests do have volatility, but at least we're in a better position there. The other point is that we actually have a framework that we already know that we're working in, right? We have a framework where CCAR works. We have a framework that we understand, the RWAs, et cetera. So those are all the benefits that I see with a Pillar 1 approach and one stack approach associated with putting the SCB in it. Now, there are some shortcomings that I think one needs to work through, and I'll break those down sort of into three components. The first that I would note is that your test is only as good as the underlying test itself, right? So yes, a stress test is a great idea, but there is a lot of model dependency, which was discussed on the last panel. And the deviations between the DFAST and the stress test results that the Fed has actually given most of the banks is growing in certain places. And there's a growth that is not very well understood that I think would be helpful and hopefully will be addressed when we have model transparency. But it goes back to a question that I asked Till on the panel, which is, there are changes within industry dynamics. I think that there are industry-level models that don't account for the different business mixes that different banks have, and I find that to be a shortcoming with some of the models that when we think about the overall papers from the CCAR exam that I think need to be looked at. The second point that I would make is that if we do begin to apply Basel into base versus stress, is we have to understand what's the overlap. And I note that within the concept, I think Shira mentioned it, within FRTB and where is GMS, and then also with ops risk, right? Is ops risk in the CCAR exam was intended to solve the question that you didn't even have an ops risk calculation. Well, if you're also putting it into base and you have ops risk in base, does it need to be stressed at the same level? So I think that those are some of the questions one needs to grapple with. And the final point that I would mention on the SCB in general is we talked a lot about, and Morgan Stanley's commented as well, on the dividend add-on. The dividend add-on is just another place where you could say that there's overlap. The ERI test was intended by Basel to make sure that you'd be in a position where you can sufficiently pay out your dividends. The US-based system created, an additional dividend add-on that I find to be unnecessary and is specific to the United States without taking into consideration the usabilities that you might have already from the ERI test.
Thank you for all that. Mike, how else should the stress test regime be improved? And feel free to comment on the transparency and volatility, which came up in the last panel as well.
Well, I think as we've been discussing today, there's a focus on models and the model documentation. And the models, of course, are important tools, but they are backward-looking. And I think that set of efforts needs to be balanced with really understanding the range of environments one can operate in and what are the capabilities and tools you need to manage through that environment, and ensuring that you can operate in that environment and maybe mitigate some of that risk before that environment unfolds. So I think the focus has been perhaps too backward-looking on the models, on the documentation of the models, including models that you may have not used. So I think there needs to be a balance with the practical application of capabilities for that environment.
Darryl, I know you have comments too. Thanks, Mike.
Yeah, I just want to bring up the point that John McDonald brought up in the last session. There are other constituencies besides banks and regulators that use these stress tests. The investors, both fixed income and equity, but also rating agencies. And this is the one test publicly that everybody is judged against, and they can kind of see how the performance is. And that's a real critical process in the system and how they incorporate it as well. So it's used by others than just the Fed in making decisions from that perspective. You know, as far as models go, I would say getting the models right is really important. Transparency is a start from that perspective. But you know, banks need to better understand how their models are built so we understand the risks, so we can incorporate them into our risk management. And we really need to, I believe, that both us and the Fed really work with each of our models together so we can share best practices and basically how to model our portfolios. I think that would be really an improvement. And after the results are done, maybe have a process in place where we can calibrate or adjust for maybe next year as well, as we can kind of get better. I'm in the mindset we're always trying to get better, always trying to improve, and just putting processes in place like that I think would be helpful.
Raul?
Yeah, I think on the stress regime, in the most recent cycle, the data being shared, I welcome in that action. Individual banks were shared. At least we are consuming. There are more questions, but at least it's a good step forward in terms of how that transparency process has started. I think going back to some of the questions is the three things which kind of in the stress test regime we look at. One is the model itself. How are they calibrated? Are they calibrated to individual banks' nuances in terms of, or are the, as Sharon mentioned, the industry averages being put in? The second thing also is what are the scenario assumptions? And I think that's another area to look at. And then the third thing is what is your starting point financial and business model? 23 was a challenging year for banking in general. 24 was different. Clearly that would have an impact on PPNR modeling as things look forward. So I think those are some of the observations.
Great. Let's turn to the Basel endgame. So how should it be fixed in the United States? Sharon, you want to lead us off on that one?
Sure. It's a passion topic for me. I think that when you look at Basel, there were two things that I think weren't necessarily taken into account. One was what was already existing within the US framework, so where are there overlaps, as I've mentioned. But two, there were questions on how the underlying financial system, or I think underappreciations is probably a better word, of how the US system worked versus systems abroad. And I'll explain what I mean by that. The first is, I really think that there were two fundamental issues that I would speak a lot to policymakers about. One was operational risk, and one was on the market risk side. So if you first look on the operational risk, Basel itself said that it had issues with its service components and the way that it was measuring ops risk. Despite the fact that Basel noted that there were shortcomings, the U.S. implemented or suggested to implement the operational risk exactly as Basel stated it, really looking at a revenue line item, which is not, I don't think is appropriate for many reasons. But then beyond that, when you actually went to the underlying pieces, it didn't give credit for certain less operationally intensive businesses like wealth and investment management. I do know that the Fed, obviously, in its most recent speeches discussing potential reproposal, underscored and understood those issues. But it was, I think, again, as I used the word, an underappreciation of the fact that there was, where the service revenues were coming from, and that there is a lot of historical evidence that those businesses do not come with the same operational risk that you might have in other businesses. Then as it relates from a market risk perspective, particularly FRTB, and I'll echo a lot of what Shira said in her commentary, is that the U.S. is one of the deepest, most liquid markets in the world. Tiffany said that as well. And when you look at the depth of that market and the dependence on the capital market system itself, you have middle market issuers, for example, and this is just one example, who are highly dependent on our capital market system. Now,
Despite that, FRTB, for example, would look at somebody who has less observable data points, even if it has the same credit rating as a large institution, and would penalize it. We would charge them higher prices, and you're making real economic decisions to Main Street. You're making choices without really understanding how our system, our fundamental system works. That's just one example, and there were many when we were looking at FRTB where I think someone needed to take a step back and say, how does this impact the real economy, and how does it impact the U.S. economy and the way that the U.S. economy has been built and the capital market system has been built. Separately, from an FRTB perspective, as I said on the onset when I talked about overlap, parts of the GMS were really do have an overlap between base and stress, and that overlap was not taken into account when you actually looked at the market risk. It goes to the final point that I'll just make, which was asked by Randy on the last panel in terms of the cost. There are some benefits of, an IMA approach when you looked at FRTB, but they're very expensive, and it's a very expensive process to run. So much so that many institutions would just choose to use a standardized approach. So I think there has to be a weighting between what are you trying to achieve and what's the actual cost from the bank, and then, like I said, continue to look at the various overlaps.
Raul, you part of a bank that manages the regime in another country as well as here. What are your concerns about reform, the Basel Endgame in the United States?
Sure. Our bank in the U.S. is very much like a super regional, similar to John and Daryl here. So just in terms of our business model, our risk profile, and also the footprint. So not much different than what they would also have. I would reiterate the same things as the capital framework. Is it balanced to address the risk and the economic growth? Is it holistic and avoiding unintended consequences? And I go back to clear and transparent. So not very different than what the regionals are seeing.
Yeah, just briefly, I would preserve tailoring, I would avoid excess complexity, and consider interaction and stress test with other roles. As far as what we liked in the prior proposal, I keep AOCI in the capital calculation, and I would also look at the low LTV adjustments that were made from that perspective. I think it's important in the reproposal, the overlapping of capital, including stress test operations that was talked earlier, I think are the important points.
Alistair, anything?
Well, I'll just reinforce what Sharon said and what Shira said earlier. This overlap between the regime in the United States with stress capital buffer, there's already operational risk shock in there. There's already global market shock in there. The Basel III Endgame addresses where that doesn't exist in the rest of the world. That's good. It doesn't need to happen twice, though, in the US. So we just got to think about that. I know that's not easy to solve, but that duplication, that overlap is really important for us. And then, Sharon used that example of you need to have a listing in order to get an investment grade RWA weighting. That's another example of, I'll call it US gold plating. I'm not really sure we need that. The way we would look at a company is whether it's listed or not, it's probably got the same credit risk, all things equal. So that's the sort of thing that has a real Main Street impact, and we'd want to go through those sorts of things.
Great. So we got about 5 minutes left. Last question for the panel, a real practitioner's perspective here. So we've talked about a supervisory pivot to focus more on core financial risks. So what are the implications for you as CFOs of such a pivot, especially considering all that's been talked about today? What might it mean for your staffing, data, operations, technology? Daryl, can you lead us off?
Yeah, so I think banks' risk management is really focused on the key risks that I talked about. Credit risk, interest rate risk, liquidity, operational, and cyber. So you start with that. As far as processes and operations, if we know that we have to do, for example, more stress scenarios, we will set up more processes, we will put in more operations, we'll get more automation. We may not get it there the first year, but we're always trying to optimize and always get as efficient as possible. I mean, the less handoffs that we have and the more automation that we go through, we will build out. So the first couple of years could be painful, but I think over time, if the requirements or increase, we can adjust to that.
Other comments? Alistair?
Well, I mean, I just think when it comes to core financial risks, we obviously welcome that idea. It's good to remove some of the, I'm going to call them the non-rule rules. It's so much easier for us as practitioners when there's a law or a reg or a rule. It's easier, it's more durable, it's less subject to interpretation. So it's much easier for us to scale around that. You know, what happens as a result? Less burden on our resources, more focus on key risks, and our people can spend a lot more time taking care of clients and their needs and driving growth in the economy.
Mike, any other comments on this?
Yeah, I would just add that, again, we too would welcome reforms in this space, and I think this does allow for greater tailoring of focusing on the risks that are key for your financial institution based on your business model, based on the clients you serve. So we would certainly welcome reforms in that area as well.
Great. John, anything last? You're good?
Those are great comments. I don't have anything more.
Terrific. Okay, well, there you have it, the CFO's perspectives. Vice Chair Bowman, thank you so much again on behalf of all of us for setting up this terrific conference. We really appreciate it. Thanks to the other panelists. Thank you.
Well, I can't believe it, but we've finally concluded our last panel. I just want to thank so many people for being a part of today and for helping us put this together on, I know we've said it over and over again, but the first of its kind conference where we could bring industry, academics, stakeholders together to hear from each other about how we should be thinking about looking at the capital framework and seeing where we have some opportunities to make adjustments. I want to thank Chair Powell and Secretary Besant for being our speaker last night at the dinner. I want to thank all of our board members. I think nearly every one of them came at some point of today. I want to thank our Fed staff, especially our AV and our operations teams, our catering and service teams. They kept us fed and watered all day today. And I want to thank especially my team, who always exceeds my expectations, and now they've exceeded all of yours, I think, as well. So they're not interested in other jobs, let me just tell you that right now. But I want to thank especially Alex Wells, I want to thank Amal, and I want to thank Francisco and Randy, and so many of my other advisors as well, but they were really integral in putting all of this together in such a short time frame. I want to thank all of you as our panelists. We'll be calling on you, I know, as we're working on developing some of these ideas and thinking more deeply about some of the thoughts that you all have shared with us today. Let's see, I want to also thank, I didn't mention that we had several of our Reserve Bank presidents here today. So that was really exciting as well. And we're doing this during blackout, which is really a taboo thing to do. So in particular, I want to thank Chair Powell for giving us the opportunity to do this at a time where usually we're locked down and not talking about very much of anything. But thanks everyone for being here. I look forward to your feedback and seeing how we can think about doing this more in the future. Thanks everyone.
as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial about the Fed.
was just here to say that we will start the program in about 5 minutes, so I just want everyone to get seated, but thank you so much for taking care of that for me. So in about 5 minutes, we will get started with Chair Powell. Thanks so much.
I'm here to deliver the 4-minute warning. Not really. Let's get started. Good morning to everyone, and welcome to the Federal Reserve Board. I'm very pleased, though not surprised, to see such great interest in the topic of today's conference, the integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this audience will know well, we have proposals outstanding or in the works across all 4 areas. Our regulatory capital framework and all banking rules are implemented through supervision, an area where Vice Chair for Supervision Bowman brings deep experience as a former banker and state supervisor. As she has noted, we need to make sure that our supervisory practices focus on the critical areas that determine safety and soundness. We need our large banks to be well capitalized and to manage their key risks well. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth. The Fed is a dynamic institution. We're open to hearing new ideas and feedback on how to improve the capital framework for large banks, and I look forward to hearing from today's participants. Thanks again to all of you for joining us today. Thank you.
All right. Thank you so much, Chair Powell. Welcome, everyone. My name is Amal Vaidya. I'm sure I've been inundating your email box with Capital Conference 2025 emails for registration and logistics. I will go over a couple of quick housekeeping things, and we will start the next panel at 9 a.m. As you know, this is a secure building, so our colleagues in law enforcement do ask that you keep your badges on you at all times. If you need to step out for a moment, anyone who you see that does not have a badge on is Federal Reserve staff. They are part of our events team supporting this great event. They're happy to escort you to a coat room or step out to make a phone call. On that point, we do ask that you silence or put your cell phones on vibrate for the duration of this event. And with that said, we will get the next panel started at 9 a.m. Thanks so much.
to go? Good. Good morning, everyone. Before anything else, I want to thank Vice Chair Bowman for setting up this really engaging conference. We learned last night at dinner that this has all happened very quickly, and then this is essentially an unprecedented type of conference for addressing proposals for new rulemaking. So this particular panel has been asked to address changes in the enhanced supplementary leverage ratio, or ESLR, and various other leverage ratio related capital requirements. In the notice of the proposal for rulemaking, the agencies have noted that this virtue of a simple and transparent rule has some unintended adverse consequences, the focus of which in the agency's proposal is the implications for intermediation in the U.S. Treasury market. So what the plan for this panel is that I'm going to ask some questions to the panelists, who I'm going to introduce in a moment, that we have teed up in advance. But in order to keep it lively and engaging, I'm going to get some candid reactions across the panel to each other's comments. And then I'm going to turn it over to you all for questions and answers. So prepare your thoughts and give us some challenging and useful questions, please. So to introduce the panel, to my immediate left is Tiffany Eng. Tiffany is the Global Treasurer of BNY, a financial services company and primary settlement provider for the U.S. Treasury market. Tiffany is a former OCC regulatory attorney. To Tiffany's left is Don Cohn, whom everybody knows, Senior Fellow at Brookings. Don is a former Vice Chair of the Federal Reserve Board and former member of the Financial Policy Committee of the Bank of England. To Don's left is Brian Monteleone. Brian is Head of Global Investment Grade Credit Research and Senior Bank Analyst at Vanguard. Prior to Vanguard, Brian was a top-ranked credit analyst on the sell side, covering global financials for 20 years. And to Brian's left, Hal Scott, Emeritus Professor, Harvard Law School. Hal is also Adjunct Professor at Harvard Kennedy School and Director of the Committee on Capital Markets Regulation. And finally, to the far left is Ben Wiener, partner in Sullivan & Cromwell's Financial Services and Capital Markets Groups. Ben advises banking organizations on regulatory capital, stress testing, resolution planning, and capital market transactions. So I'm going to ask Hal to set us off on first principles. Why do we actually have a leverage ratio rule? And what is the history of this requirement? Do we actually need a leverage ratio rule? And does the backstop rationale for that rule still apply today? Hal?
Thank you, Darrell, and the organizers of this conference. The leverage ratio sets, as you know, a minimum. Sorry. The leverage ratio sets, as you know, a minimum capital level for bank based on its total value of its assets, regardless of the riskiness of those assets. It operates in parallel with the risk-weighted standards, which set separate minimums that do vary based on riskiness. The theory is that without a risk-insensitive leverage ratio, a bank might be free to expand its balance sheet by acquiring riskless assets without limit. But this is not a realistic model of how banks operate. Banks seek to employ capital to the highest returning activity. So what is the history of this requirement? The basic leverage ratio was not adopted in concert with the other aspects of our capital regime as part of any integrated whole. It is a vestige of the pre-Basel era. So before Basel, all we had was a leverage requirement. And it was their finding fault with this leverage requirement that actually led us to risk-based capital. So indeed, With the introduction of Basel's risk-weighted approach, the banking agencies intended that risk weight standards, not the leverage ratio, would take over as the primary determinant of a bank's capital. After the financial crisis, the largest banks were then subjected to the supplementary leverage ratio, and in the case of GSIBs, the enhanced supplementary leverage ratio, ESLR, which is a more stringent version of the SLR. Importantly, when the banking agencies implemented Basel I's risk-weighted standards in 1989, most commentators argued that the leverage ratio should be dropped because having two separate sets of capital requirements would be duplicative and unnecessary, and the risk-based one was better than the old leverage one. And the agencies seriously considered doing away with the leverage ratio, but they ultimately chose to retain it. They were not confident in the accuracy of the novel and untested, then, risk weightings. And at the time, risk-weighted standards only accounted for credit risk, not market, operational, or interest rate risk, which was also an important part of thinking about bank capital. But we're far along now in the process. Here we are in 2025, and risk-weighted standards have evolved during this period of time. They have since their beginning been supplemented to incorporate market risk and operational risk, and now incorporate complex modeling that did not exist at the time of Basel I. Moreover, interest rate risk is continually monitored by bank examiners as part of the supervisory framework and could be incorporated into risk-based capital if you wanted to do that. We also have several other safeguards in the capital framework that did not exist at that time, like the stress testing regime. So there are strong arguments that the concerns that motivated the retention of the leverage ratio have been mitigated by subsequent enhancements and refinement of the overall capital framework. The leverage ratio is now a frequently binding requirement for the largest institutions, meaning that it requires more capital than the risk-weighted standards. This is inconsistent with the agency's original rationale for retaining the leverage ratio, which was that it would sort of be a backup for the insufficiency of the risk-weighted requirements. Bank capital levels, in conclusion, Harold, are at all-time highs now, well above what Basel and other jurisdictions required. I think we need to step back at this point, which is the whole purpose of this conference, and ask ourselves, with respect to the leverage ratio, not only focus on ESLR, but whether we need it at all. Thank you.
Thanks. Does anyone want to react? What about the issue of intersecting types of capital requirements? Does that cause problems when different banks are subject to different rules at different times? Any views on the panel?
Well, I can offer two observations about the role of the leverage ratio in the broader framework. One is just, I know this conference is primarily focused on large banks, but we do have the community bank leverage ratio for smaller community banks. So there can be benefits in having a leverage ratio for particular institutions. They could have a simpler framework. But I think also the fact that the leverage ratio is itself simple also illustrates one of its potential benefits. I mean, we've seen in stress periods, there's often a focus on simplified metrics. That was certainly the case during the financial crisis. To some extent, it was also the case during 2023. It wasn't necessarily the leverage ratio that was a focus, but there was a focus on things, metrics such as tangible common equity or others that are simple. So the simplicity of the leverage ratio, if it's properly designed and calibrated, could play a complementary role, both for smaller banking organizations if they wanted to have a simpler framework versus the complexity of calculating risk-weighted assets, but also more generally to have a component of the capital framework that sort of the benefit of it is its simplicity, particularly in times of stress.
There's also the issue of assets that turn out to be more risky than they are modeled to be. And this is a backstop for that. So the obvious example from history is AAA subprime mortgage tranches, which weren't really AAA, but were modeled to be AAA, and capital held against them, and it was a disaster.
Yes, Brian.
I'm interested,
when you look at 2023, leverage requirements didn't necessarily catch the buildup in what seemed to be risk-free assets at some banks that ended up having trouble. So I think, and the important thing is, as Ben said, properly calibrated. And it's difficult to perfectly calibrate a risk-based or a leverage requirement in advance. So I think, vigilance and staying on top of, risk is ultimately the key. You can't just rely purely on, either of these. There's constantly new risks emerging. Something like CRTs, certainly growing in use, not very well, not great disclosure around it. It's just, I think, staying on top of those risks as they come up is as important as where these are set.
So some support for the backstop principle. Tiffany?
If I can add to that, the leverage ratio is one piece of the puzzle. So banks are managing to capital, interest rate risk, liquidity, and all of those as part of a holistic risk framework is important. I think about stools on a table. Each leg needs to be strong. And so to Brian's point about interest rate risk management, that individually also needs to be a robust leg to keep the entire table stable. But the leverage ratio itself can't overcompensate and make up for any weaknesses in other areas of risk management.
Hal, did you want to react to anything, any of the reactions to your comments?
No.
No? Okay. I sense a degree of alignment on the panel on this. Okay, Tiffany, you're the Treasury market expert. And as I mentioned, there's been a big focus on the unintended consequences for the Treasury market of this rule. So regulators have cited, in fact, in the proposal, Treasury market functioning as a key reason to recalibrate the leverage ratios. But is it better to lower the leverage ratios embedded in SLR or ESLR and the Tier 1 leverage ratios? Or would it be better to have a more targeted fix to address Treasury market functioning, like exemptions?
Thank you, Daryl. And let me kick off by thanking Vice Chair Bowman and the Federal Reserve for bringing us together today on this important topic. Let's spend a moment on Treasury market functioning. As a treasurer, that topic is so critical. We use treasuries for liquidity management, collateral hedging, and it's all linked to the Treasury market being the biggest, deepest, most liquid bond market in the world. Stands at close to $30 trillion today and growing. So supporting a resilient Treasury market is important for the broader financial system, which we're all invested in. There are two key tenets to that. One is safety and another is liquidity. In terms of safety, there are a range of enhancements already in flight, including the central clearing mandate. In terms of liquidity, supporting and deepening the market for Treasury securities, which is growing, is critical. In our seat, knowing that a Treasury security can be converted to cash easily, quickly, and in all market environments is so important. And that's all predicated on an ecosystem of buyers, holders, sellers, intermediaries. And the intermediation of treasuries is particularly important in periods of stress. At BNY, we have a unique vantage point into the treasury market, and we do see elevated treasury volumes in periods of market uncertainty or stress. In those periods, the market is operationally resilient, but we have seen periods of funding market pressures or dysfunction. And that tends to stem from an imbalance of buyers and sellers in the market. So it is exactly in those moments where having intermediaries who are ready, willing, able to support the Treasury market and the continued liquidity in the market is most critical. So that brings us to the topic here today, leverage reform. Leverage ratios across the supplemental leverage ratio as well as the Tier 1 leverage ratio in their current construct can disincentivize banks from intermediating treasuries during those periods of stress, exactly when it's needed most. And another dimension to this is typically in those periods of volatility, there's also heightened balances typically of cash or deposits on bank balance sheets. So banks' ability to act as a shock absorber for both cash and treasury securities can be constrained by leverage ratios as they're constructed today. Now, the proposal offers solutions to that, and there are a couple flavors to that, and there are considerations for each. One flavor is to lower the overall leverage requirement. And that does create extra capacity for banks. However, banks still have the discretion on how to use that capacity. And it may not be there in a period of stress. Another flavor is to specifically target cash and treasury securities and exclude those particular assets from the leverage requirement. And in that case, it's a more direct support for treasury intermediation and for banks to act as shock absorbers for cash in those periods of stress. Now, I'll posit that leverage reform is one facet of a multifaceted approach to support market liquidity. It really goes in harmony with public and private solutions, including government facilities, such as the discount window and the standing repo facility, as well as private solutions, including recent innovations such as early morning repo or intraday repo. So taken together, as I take a step back as a treasurer, every day we're focused on resilience and we're managing a range of risk measures: capital, liquidity, interest rate risk, just as I mentioned. And that's just to name a few. And we're thinking about a wide range of scenarios. We like to say, better to prepare rather than predict. If I extend that lens to reforms, and having reforms that are also supporting resilient treasury markets in a range of scenarios, that really leans towards taking a holistic, proactive approach, looking at all banks and targeting the risk at hand. And that'll help us target a future shock, because we all know that no two stresses look exactly the same. And so with that, that holistic and proactive approach and discussion is exactly in the spirit of this dialogue today.
Thanks, Tiffany. This issue of exemptions for certain safe assets versus lowering of the leverage ratio number itself came up at our dinner table last night, and there was a range of views, but rather than trying to review those, I'd like to get the views of our panel. So how about a quick run of the panel on whether exemptions in addition to or as an alternative to the proposal would be beneficial overall?
So I would be concerned about exempting treasuries because of the interest rate risk that could be encouraged. Banks would be encouraged, I think, to take with just exempting treasuries entirely. Now, I'd like the alternative in the proposal for exempting treasuries in the dealer that are on the dealer's books that are marked to market and subject to the capital, the market capital requirements. But just a blanket exemption of treasuries, I think would raise other issues that need to be addressed.
Brian, do you have a view?
Yeah, I would just say, while the proposal creates significant capacity today, there could be future states of the world where ESLR became binding again, at least on some banks, and it would be helpful to have something countercyclical to offset that, the trade-offs between different solutions.
Hal?
I prefer the approach that was taken rather than exemptions, but I would say with respect to any of these proposals, we need better data on exactly what the impact of them would be on liquidity in the Treasury market in a crisis, given the fact that the dealers only account for, not a lion's share of this market to start with.
And Ben?
In terms of specific exposure exemptions, I think it's important to think about that in the context of the broader framework. We discussed earlier the fact that under the narrow exclusion, there would still be the market risk capital requirements, but also there are many other aspects of the regulatory framework. There are also many aspects of the supervisory framework. So looking at what else is there to address the concerns if there might be exemptions for specific exposures, more of a holistic view.
Yeah, again, we haven't been able to get much disagreement. There was an intriguing remark last night at our dinner table on the implications of exemptions for Treasury securities, which is that in the international financial stability framework, some other countries might be tempted to also depart from the general spirit of the SLR, exempt their own government securities, and in some cases that might have adverse implications for international financial stability. So I'm going to turn next to Brian, and I want to address the issue that's come up already, which Tiffany mentioned, which is resilience. That resilience of the Treasury market to events like March 2020 have been more prominent in the interagency working group papers on Treasury market reform than everyday liquidity. Do you think the proposed reduction in the ESLR is likely to improve Treasury market liquidity on normal days? Would the proposal improve Treasury market liquidity during a crisis? Is there an advantage, and I think you alluded to this a moment ago, to waiting for crisis conditions, as in March 2020, before lowering or exempting from the SLR?
Yeah, great. Thanks, Daryl. And also, thanks for having me here to speak today. I appreciate it. So I'd say Treasury market liquidity today, normal times, is generally working fine. You could look across a lot of measures, on the run, off the run, spread, market depth, swap spreads, futures basis, all kind of operating fine today. That said, banks are economic actors, and to the extent there was client demand and you had a significant increase in leverage exposure capacity under the proposal, then I think at least at some of the GSIBs there could be incremental capacity deployed to low RWA activity, which could on the margin improve liquidity on a normal trading day. I wouldn't expect banks to go out and buy a bunch of long duration for their banking book, but think client financing, client intermediation. In terms of the second point around crisis, you mentioned March 2020. I think that's a great example, right? It seemed like balance sheet constraints were contributing to a deterioration in market liquidity, and regulators stepped in, much to their credit, and provided temporary relief, and that helped facilitate a return to activity. So I think a SLR that is not regularly binding certainly could and should help reduce the likelihood of a dysfunctional Treasury market in periods of stress. That said, it's just one piece. Daryl, I know you've written and testified about a bunch of the other pieces, so it's not just the one silver bullet, but I do think it would be a helpful part of that process. And then in terms of that final part about is there advantages to kind of acting before or waiting, I do think it's helpful to have some countercyclical part of it. There's different ways to do that. There's the narrow exemption in the proposal. I think the Basel standard allows for exempting reserves in certain situations. Both of those have some advantages and disadvantages. You're picking winners and losers between low RWA type activities, which can cause some market distortions. You could bucket all low RWA activity together and exempt that as a group, but that could hollow out the rules, so you might need to change the requirements. There's different things to do there. You do a countercyclical buffer, or just wait for the next crisis. Generally, I would say the market doesn't like uncertainty, and generally, I would say it's maybe not great policy to be working on emergency measures. So to the extent that that path could be explained in advance, the market could discount it in advance, and I think it would lead to better market functioning.
How about some more views? What about this countercyclical approach? Should the agencies keep something in their back pocket ready to bring out during a crisis, or should they try to fix it once and for all? Anyone have a view on that? Tiffany.
Thanks, Daryl. I agree with Brian, and clarity and having the certainty in regulations is important, particularly as we're managing our balance sheets at banks. We talk about looking at various different scenarios and preparing for a range of outcomes. In those scenarios, we're typically not assuming that there will be any change in regulatory requirements. And banks may take action, reduce activity in advance of a stress, expecting no changes. So the structural permanent changes, the advance notice of that, helps steer and incentivize the right behaviors in advance of a stress, and then reduces the need to make any ad hoc changes during a stress period.
Don?
So I've been a fan of the countercyclical capital buffer applied across capital regimes, risk space and leverage. We applied it at the Bank of England. Actually, I can't remember whether it was applied to leverage ratio. I'm looking over at Phil. It was applied to leverage ratio. I think a key, and I've advocated it and been rejected by the Federal Reserve many times. It's a familiar position. But I think the key is it's not just a one-way street that you have something you reduce in hard times. You have to make sure it's adequate in the good times, that you've got the capital high enough that if you release capital in bad times, leverage or risk-based, that the banking system is still safe. So counter-cyclical in both directions.
Other views? If not, I'm going to move on and ask Ben a question. So Ben, the Federal Reserve Board staff has estimated a $210 billion decline of capital at the GSIB depository institutions, but does that matter for financial stability given the much smaller $13 billion projected decline in capital at the GSIB holding companies? What are your views on that?
Thank you very much. It's great to be here today with everyone. When considered in the context of the broader large bank prudential framework, I think the financial stability implications of the difference are potentially positive. This is particularly the case in light of the GSIB resolution planning framework and the GSIB single point of entry resolution strategy, as well as the design of other Dodd-Frank Act enhanced prudential standards which focus on the holding company. The risk-based requirements are higher for the holding company than the bank, as you mentioned. And this reflects the fact that the GSIB surcharge and the SCB applied only the holding company level. That, in turn, is itself illustrative of a key structural feature of the current large bank prudential framework, and that's a focus on the holding company. This is codified in Section 165 of the Dodd-Frank Act, and many hallmarks of the current large bank prudential framework are all holding company standards. Some examples would include supervisory stress testing, CCAR and then the stress capital buffer, internal liquidity stress testing, TLAC requirements for GSIBs, and then the joint FDIC and Federal Reserve resolution planning requirements. The proposal explains that it would do three main things. First, restore the ESLR to a backstop. Second, address the level and marginal regulatory incentives regarding low risk, low return, and higher risk activities. And third, provide the GSIBs more flexibility in the allocation of capital among their subsidiaries. I think the proposal would actually do three things beyond that. First, it would address the arguably anomalous role of the 6% bank ESLR requirement in the current prudential framework. That's a bank level capital requirement that's calibrated to be higher than for the holding company, but based on the GSIB status of the parent. It's actually the exact opposite structure of the GSIB surcharge itself, which of course applies only to the holding company. Second, there would be more consistency in the overall design of prudential standards with a focus on the holding company. And third, there'd be more alignment with the resolution planning framework, and in particular the GSIB SPOE resolution strategy. Under that strategy, in the event of failure, only the top-tier holding company would enter insolvency proceedings. The subsidiaries would be resolved without entering into their own separate proceedings. That strategy depends on flexibility, specifically flexibility for the GSIB to provide capital and liquidity to the subsidiaries based on their needs and resolution from centrally available resources. The strategy, of course, also depends to some degree on prepositioning, which entails having some capital and liquidity already at the subsidiary level. It's a balance between the two. So the proposal would therefore have greater consistency with the structural focus on the holding company. There'd be more alignment with the resolution strategy for GSIBs. And from that perspective, there'd be the perspective to potentially have reduced fragility and stress, promotion of the resolvability of GSIBs, and therefore positive financial stability implications.
Thanks very much, Ben. What about other reactions? Is the fact that the dollars of reduced capital at the holding company is small relative to the depository institution, is that important? Is there sufficient flexibility in capital in the structure of a bank holding company and its subsidiaries? What are your views? Hal, do you have a thought on this? Do you have a thought on this, Hal?
Yeah, so as you said, Darrell, the reduction of the depository level was much higher than the reduction at the holding company level. But I think we need to keep in mind the basic framework in which the holding company of a bank has to serve as a source of strength for the bank subsidiaries. So even though you are reducing the capital level at the depository institution subsidiaries, you have the holding company still with this obligation to support the subsidiaries. So I'm not that concerned because the holding company capital is not being reduced by very much at all.
Don, a thought?
Yeah, so I agree. The fact that the holding company capital is basically unchanged is reassuring. I do wonder about the source of strength thing, though, Hal. I mean, once the capital is upstream from the depository to the holding company, downstream to the broker-dealer, or if it's not downstream to the broker-dealer, it won't do any good, right? So presumably the intent of the authorities is to have it downstream to the broker-dealer. Then you have a crisis. You have something happens that no one's anticipated. Are they really going to take the capital back from the broker-dealer and give it to the depository institution? In 2008, the board was asked to vote several times on exemptions to upstream capital from the bank to the holding company to support the broker-dealer. So I think we need to think more carefully about whether the holding company would be actually a source of strength in a crisis situation.
Tiffany.
I think that all folds together to the fact that each bank is managing to multiple risk measures, capital being one, but liquidity, interest rate risk, and other measures will also support both the IDI as well as the holding company. So all of those various constraints ultimately inform how much could potentially be upstreamed or not. So there are additional constraints as part of a holistic risk framework that we are thinking of as well.
Thank you, Brian.
Yeah, I would just add, to Ben's point, the resolution framework for a single point of entry is meant to capture sufficient liquidity and capital at the intermediate holding company to avoid the situation that Don is talking about. Can it effectively do that? It's not clear. Disclosure's not great in that area. So another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution. So you're in a situation where you're managing a failure. So it would be nice to prevent the failure in the first place.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of potentially having greater flexibility. I mean, implicit in that reference to fragility is the possibility that the point of non-viability is higher in 2015 than it was in 2008. So that's, again, a reason why I think it's beneficial to consider the capital framework alongside the resolution framework.
Wow, very complex topic. Don, I want to turn last to you, and you have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we've discussed, and doesn't impede the willingness of dealers to make markets in treasuries, as we've also discussed. But you've also noted an important caveat that any adjustment does not reduce resiliency of the banking system. So when you look at the agency's proposals, how does it stack up against these criteria that you have in mind?
Thank you, Darrell, and thank you for inviting me to be part of this panel to the Vice Chair. So you're right, I've long supported enhancing Treasury market liquidity by making the SLR, a backstop. In fact, a senior Federal Reserve official told me a couple of years ago I was using too much of my brain space on the leverage ratio. So I'm grateful to have that space freed up for something else. But as you noted, my support has been couched in the context that it not reduce overall capital requirements and resiliency. And I think I take quite a bit of comfort from the fact that there's no reduction in the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue that I'd like to surface and I hope come up in agency's consideration. First, obviously, making the SLR a backstop puts extra pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track for good growth and low inflation. That's what's priced into financial markets. but we shouldn't be lured into complacency. Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard, but we know banks and bank regulators, from history we know banks and bank regulators are not immune to this particular disease. And the tails of the distributions around the central tendency seem unusually fat, as we are in uncharted waters with respect to the evolution of the global trading system, the ratio of federal debt to national income, and challenges to the independence of the Fed. So I think the risk of unanticipated developments are particularly high right now. And it would be preferable to evaluate this proposal as part of a holistic review of all capital requirements. In that respect, this is a terrific conference putting all this together. There's so many in the risk-based capital. There's the Basel III Endgame, GSIB requirements, and the stress tests, and how are they all going to fit into this? So were risk-based capital requirements the first line of defense weakened, I'd need to rethink my support for reducing the backstop, and I urge the agencies to put the whole package together before signing off and in one piece. And the second point, I want to come back to something that came up before, and that is releasing capital at the DI will not reduce the resilience of the overall organization, but you will be encouraging. In fact, one of the benefits cited in the thing is encouraging banks to buy Treasury securities, so it does expose them to added interest rate risk, widespread losses on Treasury and agency securities contribute not only SVB's problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23. So banks should be required to mark securities in the available for sale portfolio to market, and the available for sale portfolios should be subject to market risk capital requirements. Bank interest rate risk management, even for the hold to maturity portfolio, should be subject to close scrutiny. And as I noted, my concern about interest rate risk would make me very reluctant, would make me opposed to exempting all treasuries from the leverage ratio.
So the gist of your remark is that you want to see the whole package before a final view on it.
Yes.
Yeah, interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind that the U.S. banking system is today very well capitalized. U.S. GSIB actual capital levels have increased 17% over the past 2 years, and our minimum capital requirements are now 1.7 times higher than the Basel requirements, $837 billion versus $473 billion under Basel, because of our stress testing regime and gold plating. Keep in mind that we gold plate the Basel requirements. This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay? And if it's in the background, you can further say, why do we need it then if it's now in the background? It's not binding anybody. Okay, so anyway, I think overall the U.S. banking system is in a very good place today in terms of its actual capital levels.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of U.S. banks to compete both with non-bank financial institutions and with international banking institutions. First, is that competitive angle, does it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that U.S. banks have been at or GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Gerald, quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, You know, when we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, well, get them on an even playing level, they'll have to have the same capital level as we do. But then it turns out they have different accounting systems, they have different government subsidies, they have different forms of regulation that have nothing to do with capital. So you have to add all of that into the picture when you're thinking about competitiveness.
Any other reactions on competitiveness? Brian.
I would just say, certainly, we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks. I think certainly non-bank financials have significantly increased their scale and scope in some of these businesses, and obviously they don't have the same regulations, so that might have merit.
Moderators don't get to vent their own views, but it does seem like better capitalized banks are better able to compete in principle.
Yeah, that was the point I was going to make. I don't think the UK, European, Japanese banks would think that they're at an advantage because their capital hasn't been gold-plated. I think the U.S. banks are pretty much competing very, very well in the international field. And there are times when being well capitalized, having high capital is to your advantage because, of course, under stress, there's much less to worry about. We saw that in the U.S. in the March 23 situation where deposits fled from regional banks where people were concerned about the embedded losses on treasuries and other things, and they fled to the GSIBs. And some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized and much, much less likely to fail.
I'll make one observation, which is
go ahead, Ben.
that you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. And that does clearly illustrate that they're marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between U.S. and non-U.S. requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management. It's a strong pillar. It's an important risk pillar. And as I mentioned, it's an important part of the overall risk management framework for banks. Second, the holistic review, I think, is an important point as well because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the treasury market. So I think that holistic review is also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. If we have a second round, we can come back, and not a speech, just a question, please.
My name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently Category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio. The other one is Tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios, and I disagree with both of them.
Okay. I'm watching for hands. Yes.
Hi, Sharon Ishai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress, where they could be using it to lend and still put on an additional countercyclical buffer on top of that. So it's almost as though the concept behind having overlap is not necessarily taken into account from a buffer mentality, where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the two leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the countercyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and I think as I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had countercyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So the whole, maybe I didn't understand quite your question totally, but the whole point of the countercyclical buffer is to encourage lending in stress situations, or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak. I'm
Sorry,
the
Bill,
CEO of
pardon me.
PNC. Just an observation. This entire conversation on leverage ratio and then pointing to the functioning of the Treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different ways without going to the Treasury market. We can do it off balance sheet through swaps. What we're simply talking about is it a good idea to give GSIBs the ability to grow their prime brokerage operation to support the actual capital providers into the Treasury market today, which are principally hedge funds. And by the way, I am in favor of that, but I would reduce the conversation to that, because I think our issue ultimately becomes the size of prime brokerage across Wall Street as opposed to what the leverage ratio is.
So Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered?
Yes.
Because banks, and now you've got a stress hits, and the margins start increasing, and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions, the big banks finance the auctions. If you get an off-the-run treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the treasury market to function because we're running the biggest deficit we ever had, and it's likely to grow, so therefore I need to get capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up actually to Bill's observation.
Could you give your,
sure.
your name, Pete?
Peter Blostein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more Treasury market liquidity, namely proprietary trading in the Volcker rule? Should banks rebuild relative value fixed income desks that all migrated out of the banks post-Dodd-Frank, post-Volcker, and that should be the place for Treasury market intermediation rather than hedge funds as Bill suggests? Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of the discussion today. I do think in the context of intermediation is one piece of the Treasury market. Certainly that is a very important activity during a period of stress, but to the point of it's a 30 trillion, close to 30 trillion market today, growing. Intermediaries are one player in that market. Buyers and holders across all different banks is something that we need to and should consider to continue to support that market. So that's the kind of broad view, and looking at broadly regulations overall is, I think certainly the leverage ratio is a step in the right direction, but taking that big picture view as part of that holistic discussion that we're having here today as well.
Yeah. Subjected to market risk capital.
Market risk, interest rate risk management.
Interest rate risk management, right.
The proposal does cite some research, for example, by Falk Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to Treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing, to Bill's point, in the Treasury market. So there is some research in support of what you're all saying. Other?
Daryl?
Yes, Hal.
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Darryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Darryl. All right.
Sorry.
Norbert Michel, Cato. Hi.
Yeah.
Sort of an efficiency question along the same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your light
Yeah,
on.
I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. And I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low-risk activities like that, even if they are put into cash and not 30-year Treasury bonds. Just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this? Ben.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low-risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic Tier 1 leverage ratio. Their 4%, 5% structure in the prompt corrective action framework's been around for a very long time. When it first was implemented, I would be very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low-risk activities that are related to deposit-taking, liquidity risk management, I think it's a very important consideration.
Tiffany.
I agree. As you mentioned, Al, heightened cash balances, heightened deposits, particularly in a period of stress, it typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was. So I think, as I said, I would be opposed to exempting Treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
If I could, I just have a quick add-on that ought to be part of this discussion, and that's FDIC insurance on size of your balance sheet. They're the only measure still left where you go period end. And so one of the reasons you see repo get very tight at the end of a month is simply because everybody's calculating their balance sheet on period end. If they averaged it, you'd likely get rid of the month-end crunches. It seems to be a pretty easy fix.
Good to know. Okay, so we've run our allotted time. I just want to thank the panel for an extremely illuminating discussion. Lots of back and forth, good audience participation. I learned a lot. And I want to thank Vice Chair Bowman again
for inviting us to speak here today. Thank you.
All right, we'll get started in about 30 seconds. So if you haven't taken your seat already, I ask that you please do so.
Good morning. My name is Jonathan Gould. I'm the 32nd Comptroller of the Currency. Although I was sworn in less than a week ago, it's great to be here. And I look forward to engaging on these very important issues going forward. I greatly appreciate the range of perspectives and views that are being presented here today. And I thank the Vice Chairman for Supervision for her efforts in this area and her invitation to attend today's event. One of my areas of focus as Comptroller is ensuring regulation and supervision are properly calibrated and appropriately focused on safety and soundness. To that end, I believe it is prudent to consider the appropriate risk tolerances and capital requirements that are required for the largest banks, and how these choices may impact other banks as well. This next panel is focused on the evolution of the capital framework, including what has come to be known as Basel III. This distinguished panel will share their thoughts on several topics of interest, including the global framework, tailoring, interactions with other prudential requirements such as stress tests, and the impacts on economic growth and financial stability. I'd like to thank our distinguished panelists for appearing today and would like to turn the discussion over to panel moderator, the inimitable Rob Blackwell. Thank you.
Thank you very much. Thank you very much, and thank you to Fed Vice Chair Bowman for having this conference. This is very exciting. I have a wonderful panel in front of us. I am not going to do justice to any of their biographies. That way we can get straight to the questions and presentation. But so that we'll give you a brief overview. Phil Evans, to my left, is Director of Prudential Policy at the Bank of England. As part of that role, he's in charge of implementing Basel Endgame in the UK, called Basel 3.1 there. He previously was in charge of coordinating the bank's work on the UK's withdrawal from the European Union. Shira Friedman is the Chief Accounting Officer and Controller for Goldman Sachs. As such, she is responsible for the oversight of external and internal reporting, product control, and regulatory capital. Randall Quarles is the Chairman and Co-founder of the Synosia Group, a Utah-based investment firm. He was the first person to serve as Vice Chair of Banking Supervision at the Fed, serving that role for 4 years between 2017 and 2021. Last and not least is Mike Mayo. He's Managing Director and Head of the U.S. Large Cap Bank Research at Wells Fargo Securities. He is the first analyst to testify on the causes of the great financial crisis, and he is representing himself, not the views of the bank. So I'm going to actually kick off right. I just want to make that clear from the outset. I'm going to kick it off, and you'll see why in a second. I'm going to kick it off directly to Mike, who's going to give us an overview, a brief overview, but very entertaining overview of how we got here. When we talk about Basel Endgame, what are we looking at, and how did we end up in this place?
Well, Rob, thank you, and thank you to
The mic button. Sorry. Mic to the mic. Yeah, it's the button with the voice.
Oh, it's the big with the mouth.
Yep.
Okay, there we go. Look what I found in the hallway as I came. Look, I love the idea of a regulatory reset. Let's keep banks safe and sound, but rip out as much bureaucracy and red tape as possible. And so I'd start with, first, thank you, regulators, for what you did after the global financial crisis. You made the system so much more strong than elsewhere around the world, and I'll spend 2.5 minutes on these. But the system today, it's too confusing, too constraining, and too costly. And when I worked here in this building 35 years ago, the capital rules were simple and weak, and today they are complex and strong, so let's make them simpler and strong. And I did a proprietary survey to institutional investors. Those are the largest pension, hedge funds, mutual funds around. And 9 out of 10 investors, these are the owners of the banks, find the capital rules confusing. There's too much regulatory risk. Regulatory risk wasn't even a phrase a few decades ago. There's other risks you have to contend with, not the 4 words that strike at the heart of investors. What will regulators do? There's too many targets, it's acronym soup, and too much capital volatility. It's too much of a black box. You don't know the cost of goods sold until after the fact. I mean, if you're selling steak au poivre and you don't know the cost of the steak till after that's a problem. Look, nobody wants to go back to 2007, but right now the pendulum swung too far. Same investor survey, 9 out of 10 investors find regulation too strict. Too much marginalization of banks. If you look at loan growth by decade, the last few years it's been flat to negative, inflation adjusted. Too much disintermediation, marginalization of banks, too much business leaving the banking system. And too much disregard of de-risking. 15 years. You've done a great job, regulators, as of 10 years ago. You've doubled capital roughly. You've doubled liquid assets. Banks have not stretched for loan growth. But as I learned here, I learned my best lessons here at the board 35 years ago. If it grows like a weed, maybe it's a weed. Banks have not been growing loans like a weed. And look at what the $7 trillion investment-grade bond market says about bank safety. They're saying banks are safe. In fact, they've said banks are safe for most of the period for the last decade. And it's too costly. These are our best estimates, but roughly 20% of bank expenses are related to regulatory, compliance, cyber, all in. And then when we poll large banks, they think they could maybe save 10 to 20% of that. So you're looking at a possibility of saving 4% of expenses. And in our investor survey, what investors are looking for are greater efficiency from regulation and greater loan growth. And there's too many moats around the largest banks. Talk about unintended consequences. By the way, when I worked in the application, the merger group here 35 years ago, we would approve mergers in 60 days. And we had one review said I looked at 100 applications in a year or something. And the unintended consequence is, fine, I'll just keep increasing my price targets on the largest banks. We should have more trillion-dollar banks to compete against JP Morgan. Goliath is winning. They're gaining share. And then there's the loss of talent. For every executive that comes in the banking industry, 5 are leaving. Talent drain. So 10 unintended consequences, too much regulatory risk, complexity, targets, volatility, marginalization, disintermediation, expenses, loss of talent. But there's hope. Let's see if this works here. The hope is this. I had to bring children's scissors to fit through the metal detector in the airport. Well, this is the hope, okay? That's the hope. And the end result here then is just win-win-win. Regulators, you can have more efficient oversight. The banks, yes, they'll be more profitable, more efficient, but the customers will have better terms and more options. So with that, I was going to hand this over to Phil, who can describe how we got to the state in Basel III.
Oh, blimey, I think I'm going to be a bit less entertaining than that. So I thought I'd take this two ways, basically. So I talk first about the benefits of having a kind of an internationally aligned approach. What benefits does that give us in general terms? And then I'll get on to the specifics about why this Basel Endgame package is, why are we doing it? So on the general, and I guess this is one of the key points I wanted to get across today. I mean, I'm going to argue that international standards are things that we benefit from. The reason we do them is we get benefits. And there are many that you could talk about. The two that I would pick out are, in terms of, first, international financial stability. So we are and still remain so interconnected that when something goes wrong globally on financial stability, it affects everyone. And those costs are deep still. And the second is on the role of international standards promoting trade in financial services. So, you know, large global banks have economies of scale and scope, and part of the way they get those is having similar rules across borders. So it's what allows domestic banks to operate abroad and foreign banks to operate domestically. So that's the general. What about the specific on Basel Endgame? So as Rob said, our version of that is called Basel 3.1. So we couldn't quite bring ourselves to call it Basel 4, and so we had like a tiny eeny weeny Basel 3.1. But my guess is we were kind of like we were looking for the same kind of comfort blanket that you guys were when you called it Basel Endgame. It's part of the post-GFC reform package, so it's the third bit. First two bits were about the quantum of capital and then the quality of capital. So quantum we've done already. So I don't think that the Basel Endgame package needs to be about the quantum of capital at all. What is it about? It's about measuring risk better, right? So the standardized approach we have at the moment, the standardized approach is always going to be blunt, but it's just very blunt, the one we have at the moment. And so we're kind of tilting it just so that it picks up risk better for the right activities. And that is important in its own right, but it also has benefits for competition, because one of the things that we feel strongly in the UK is that smaller banks have been unable to compete on low-risk activities because they're forced up the risk curve by this very blunt standardized approach. And so a big benefit is to improve competition. On the model risk weight side, we kind of lost confidence in that a bit. So we had these papers post-crisis where we were running experiments. We gave firms the same, exactly the same scenario, run it through your models, and they throw out completely different risk weights. And that kind of drains confidence. So one of the things we're doing in this endgame package 3.1 thing is a bunch of things to try and bring back some of that confidence again through things like the output floor. So I'd argue there's a lot to like about international standards in general because they give us benefits, but this particular package is balanced and gives us some good things.
All right, well, thank you very much. As everyone in this room knows, this is not the first time we've taken a run at Basel Endgame. So I'd like to ask Randy to start off and give us a sense of what were the mistakes that regulators have made in the past? What are things that should be avoided now as they craft this again?
Well, I guess it depends on when in the past you're talking about. Because there have been a few efforts, and some were better than others, as it turns out. But so I think there are, with respect to what ought to happen in finishing the implementation of Basel III, I think there are substantive issues and there are process issues. The first substantive issue is that these measures, even in Basel, as Phil mentioned, this isn't about the quantum of capital, and it was not about the quantum of capital when these measures were being discussed in Basel. It's about the incentives that the overall capital framework is creating, and they were not intended to increase the quantum of capital, and I think that should be a first principle of implementation here in the United States, not just because it's sensible, it's also Basel compliant. It's not intended to increase the aggregate amount of capital in the system. I think, and there have been proposals around implementing Basel III that would have done that, and I think that, I think that was the wrong direction. As a matter of process, I think it is a mistake not to get as much input as possible. And so this conference is a paradigmatic example of how one ought to go about the process of the implementation of these last measures of Basel III. From all sorts of areas. More heads are better than one. I think there have been folks who have said, look, here's a proposal. If you don't like it, vote no. And that's it is a better process to have gotten input from everybody in this room, folks outside of this room, academics, banks, public interest. I think banks are part of the public interest, but a wide range of groups. And I think if you combine those basic principles, then there can be a successful result. I would add that I do think there should be a successful result. I've heard, there have been threads over the course of the last several months that maybe we just drop these last measures of Basel. And I think that's not in the interest of the United States. Bill makes a good case for, global financial stability. I used to be a global financial stability guy. I have nothing against global financial stability, per se. But the Basel process, particularly the Basel capital process, has really always been in the fundamental interest of the United States. Hal Scott mentioned that the very first Basel was because the Japanese banks were being allowed to operate with $12.73 of capital, and they were hoovering up all the business in the world, literally all the business in the world. Those of you with gray hair around here will remember the late 80s, and it was like U.S. banks could not compete because the Japanese banks did not need to have any material amount of capital. And so the first Basel effort was to say, globally active banks will have globally consistent capital levels. Now that was, it was crude and simple, but it was a first effort. Then during the 90s, the European banks were operating with much less capital than the American banks, and so Basel II was this complicated effort to create an intellectual framework that would justify allowing the US banks to lower their capital to the levels of the European banks. The Math Club went to Switzerland. It was extremely difficult to understand, but people felt confident at the end that the capital could come down. No sooner was that done than you had the great financial crisis. Whoops, wrong direction. Capital needs to come up instead of down, and Basel III has been ensuring that particularly the Europeans, but global capital levels in general, are consistent. If you don't like what's coming out of Basel, what I say to the folks who wear my political football jersey, who believe that we go into these fora and are snookered by the wily Europeans, it's like, that's not what happens at all. If you don't like what is coming out of Basel, it's because you don't like what the US took into Basel. We generally get everything we want out of Basel in order to create this level playing field. And if we didn't have Basel, we would all be subject to these same rules because that's what we took in. And the rest of the world would not. So I do think it's very important that following these principles of not increasing aggregate capital, doing it in a sane and smart way, getting a lot of input on the technicalities, that we do finish the implementation of Basel.
Well, thank you. Shira, do you want to weigh in on where you think the mistakes were in the past?
Sure. Thank you very much. And I agree with everything that my other panelists have said. I think it's important to take a step back in light of the history journey that Randy just took us on and recognize that what is attempting to be done in Basel III Endgame is what's transpired over the last 4 decades and 4 iterations of changes to the capital framework, in that it addresses every component of the risk-weighted asset calculation and the ratio construct themselves. So it's a significant book of work, and some could argue the most significant book of work. And in my mind, there were 2 flaws in the design of the original NPR, both of which relate to isolation. The proposal was done in isolation of the other components of the capital framework, and the proposal was done in isolation relative to what was being done internationally. So as it relates to the capital framework, what's unique with the United States relative to every other major jurisdiction around the globe is that the stress capital buffer is a Pillar 1 requirement, which means it's included in your capital ratio requirements. And therefore, when you're going to overlay Basel III Endgame with the stress capital buffer, you need to be extremely mindful of the capitalization included in each, affecting the same asset class or markets or products. And it didn't appear as though, based upon how the NPR was proposed, that that was done to a sufficient level. So that's one component of where it was done in isolation, and I think didn't calibrate correctly. The second is it was done in isolation relative to the rest of the world. And there are components that was included in the NPR that no other jurisdiction in the world implemented. So for example, the SFT minimum haircut floor was included in the NPR. No other jurisdiction has implemented it. The public listing requirement to get an investment grade rating was not implemented in any other major jurisdiction in the world. And so as a result, it's not surprising that 97% of the responders to the NPR were against it in some way, shape, or form. So the good news, and part of it is, you know, the energy that you're feeling in this conference, is the Federal Reserve has the opportunity to repropose Basel III Endgame, and I agree with Randy's statements that it should be on the docket of the many things that Vice Chair Bowman needs to do. But the good news is Vice Chair Bowman specifically has discussed the importance of looking at capital holistically and the relationship between all the different components. And then from an international perspective, because most jurisdictions are further along in implementing Basel III Endgame, you know the answer as to what every jurisdiction around the world has done, and that can kind of start as the blueprint as to how the Federal Reserve wants to repropose.
Well, thank you for that. I think since it's entitled The Evolution of the Capital Framework, I want to know what would a successful Basel III Endgame final rule look like? I mean, how would we know if we'd succeeded in what we're attempting to do here?
I'm happy to start and others can weigh in. Every time a new capital rule is put into place, whether it's in the US or internationally, what essentially is being balanced is safety and soundness versus growth, innovation, capital markets, et cetera. And so in theory, you're weighing, and the regulators are weighing those two things in making all of the decisions around capital implementation. And so to the extent that the only thing you cared about was safety and soundness, you could make banks hold infinite amounts of capital. And as a result, you wouldn't have to worry about safety and soundness. But what would be the other side of that? Corporate bond underwriting would come to a screeching halt because there would be nobody available to underwrite. Corporations that want to hedge their interest rate risk or their commodity risk or their FX risk have no counterparties that they can face. Mortgage lending, credit card lending, et cetera. And so it's really about striking that balance between economic growth and safety and soundness. And so when you look at the way in which most other jurisdictions have implemented Basel III Endgame, they've really tried to achieve that balance. And in some ways, it comes back to that capital neutrality point. And so there are certain components of the rule that they've implemented that incentivizes economic growth. As an example, most jurisdictions have exempted end users from the CVA add-on included in Basel III Endgame. And that's to protect those corporations from the burden of the banks carrying increased capital associated with facing them as a counterparty. Many jurisdictions have not applied the 400% risk weight to public equity, to private equity, to all private equity, but limited it to speculative private equity so that banks can continue to participate in more mature private equity, which is often on the precipice of them ultimately becoming public equity. And so to me, a successful Basel III Endgame has appropriately balanced safety and soundness, which is obviously incredibly important, but also economic growth.
Randy, do you have a view? What does success look like?
I think that was a pretty good overview of what a successful implementation would look like. The purpose of these last measures is to create incentives with respect to bank activity without increasing the capital burden, if you will. And I think if you see bank activity modifying appropriately in light of the areas where these new capital requirements are being implemented, in a way that is supportive of economic growth, but you actually see, okay, well, the banks are changing their, we have in fact created incentives. We're seeing that the incentives are operating appropriately, and we haven't increased the overall capital burden on the system. That's a success.
Phil?
Yeah, I mean, the best way for me to answer that is to couch it in terms of the way we tried to construct our own implementation of this. So I guess there were three things. So one was from the bottom up, activity by activity. We weren't looking for too little capital, but we weren't looking for too much either. So that a kind of fair amount of capital, if you like. And then top down, we had a view that there was enough capital in the system, so this wasn't meant to be about looking for more capital overall. And then third, we were looking for international consistency. So we were monitoring what other people, what other countries were doing. So what does a good one look like? I think it looks like those things coming through. So the playing field looks level. We've got consistency across jurisdictions. We're looking to make sure that capital isn't rising. So one of the things we'll probably get onto this when we talk about stress testing, is we had a principle from the beginning that we shouldn't double count. So if there was something where we were holding capital previously in some part of the stack, and now Basel 3.1's coming in and you're holding it in Pillar 1, and it's the same thing, then you don't need to hold the capital twice. And that was a principle that we tried to build in from the bottom. It's easier said than done sometimes, so it's not always obvious what is a double count. Final thing I'd say, so I do think there's something in this for small firms. So the risk sensitivity that I mentioned, I think, is a good thing for small firms on the standardized approach. And I'd like, so I think we'd be looking for in our implementation just a bit of the leveling the playing field between small and large firms. That's it.
And most importantly, less loans to the shadows. I think one of the things that, Randy, you just touched on was this idea that what happens if the U.S. doesn't complete Basel III Endgame, and there have been some lawmakers who are concerned about the international framework as if we're deferring to international regulators of what to do here. So let me just ask each of you, what happens if the U.S. just decides not to implement Basel III Endgame and lets it go?
Yeah, an important question. I mean, I guess the first thing to say is I hope that doesn't happen because so speaking for the UK, we get tremendous value from our close collaboration with our US counterparts. It really does make a difference to have the US as an integral part of the international community. I guess a bit more concretely though, so I haven't really seen evidence of that. That it's particularly likely. So my reading of the consensus is that it doesn't seem very likely. And I guess at one level, I don't find that surprising because in the way Randy and I have tried to describe the benefits of kind of being similar across jurisdictions is good for global financial stability. It does help with leveling the playing field. And, these are all things that we recognized, that the US recognized when this was being negotiated in the first place. So I'd argue that banks, large US banks, as well as UK banks, benefit from that consistency. So you'd want to do it, I think is what I'm saying. So all of that explains why we're a long way down the track in terms of our implementation. But so, I mean, given those arguments, if the US really didn't implement, obviously that would be a major issue. And I think it would be wrong to deny that it would be a major issue. So although I think there are strong drivers to get Basel Endgame done, we'd have to cross that bridge when we come to it. But I know the US authorities that we speak to anyway understand that very well.
Sure.
Yeah, I was just going to kind of agree with my panelists. I think that although my perspective is obviously different as a practitioner, the importance of having the banks around the world on a similar and consistent capital framework, recognizing that it can be gold-plated in some jurisdictions versus other, and on all things that need to be addressed and discussed, that I do think that it's important that the U.S. implement Basel III Endgame to be consistent with the other banks around the world.
Randy, anything to add to what you said earlier?
Yeah, I think the principal consequence would be when we get to Basel IV, which we will There will be new issues in the future. We will learn things about the financial system will evolve, the banking system will evolve. There will be a need to evolve the capital framework in light of that. Other issues will arise, and we in the United States will once again say, if we want to have a fair playing field on which to compete, there are some changes we need to make, and we want them to be made consistently. And if we have not implemented Basel III, which was very much driven by the United States, we will walk into that room and people will be much less willing to listen to us, since we were the Lucy that pulled away the football the last time.
Mike, do you have anything you want to add?
Get it done, get it done, get it done. If you don't, then the cost of capital for banks would be higher than it otherwise would be.
So I want to spend a little time. There's an entire panel about the stress test, and I don't want to steal their thunder. But I do want to talk a little bit about the interplay between Basel III Endgame and the stress tests and what the relationship should be. So Shira, let me start with you. What should the relationship be between this?
Sure. It's a great question, and it's something that gets a lot of discussion. As I mentioned earlier, the U.S. is unique in that the stress capital buffer is part of our Pillar 1 requirements or part of our ratio requirements, and therefore requires a higher degree of sophistication when combining that with Basel III Endgame, because you have everything that's been capitalized in the CCAR stress test, and then you have things that are being capitalized for in Basel III Endgame, many of whom are double counts across them. So in my mind, the most egregious example is operational risk. In the results that the Federal Reserve released last month on the CCAR stress test, they included $180 billion of capital associated with operational risk losses on the banks that participated. And so therefore, that $180 billion has been capitalized for in the bank's ratios. When included in Basel III Endgame, it reintroduces operational risk into the risk-weighted asset framework. Currently, today, that only sits in the advanced ratio, so it's not part of the standardized ratio, which is the more binding ratio for the banks. And so included in Basel III Endgame is operational risk-weighted assets. In the estimates that the banks provided in conjunction with the NPR, the amount of capital associated with those operational risk RWAs was around $150 billion. And for those that don't know, operational risk is capitalizing for generally it's legal losses. That's kind of the biggest driver, but it includes any sorts of costs associated with outages, climate-related events, et cetera. It's all captured in there. So when you take the stress capital buffer loss of $180 billion plus Basel III Endgame RWAs of operational risk, which is around $150 billion of capital, what the original proposal did is just put those two numbers on top of each other. And so the question that every constituent should ask is why is it necessary for banks to hold $180 billion plus $150 billion of capital associated with operational risk? And if you look at history and just focus on the GSIBs, over the last 10 years, so decade, the GSIBs, and I can only speak to legal losses because operational risk losses are not in the public domain. The GSIB legal losses has not been $180 billion. It's not been $150 billion. It's been less than $100 billion. And that's over 10 years. The CCAR stress test is only 9 quarters. And so I use that because, again, I think it is the most egregious example. But you can look at market risk. You can look at CVA. You can look at lots of different components. And the challenge for the Federal Reserve is to look at what's being capitalized for in the stress capital buffer, which is unique, and what's being capitalized for in Basel III Endgame, and making sure that they're not double counting things.
Randy, the stress capital buffer was finalized under your watch at the Fed. Can you take us through why it's better than the CCB was and why it's needed now?
So I think that there are two parts to that answer. One is a legal part, sort of general legal principles part, and the other is a practical part. So before the stress capital buffer, and I hadn't realized this until I walked into, well, it wasn't this building, it was the one across the street, which now may never be built, but before the stress capital buffer, the outcome of the stress test, the practical outcome of the stress test, depended on what the Board of Governors had had for breakfast on the morning it was presented to them. And that does not seem to be the right way to operate a regulatory system. That's going to have such consequences for the regulated. So the basic legal principle, it seemed to me, was that the consequences of the stress testing process should be clear and concrete and measurable. They should be legal as opposed to entirely discretionary. And I should state that I'm a big fan of stress testing. During the COVID event, the fact that we had stress tests, and we ran 7 stress tests in the United States during that period, allowed us to be very confident in the resilience of the banking system during that whole time, and allowed us to continue to allow our banks to pay out dividends when the rest of the world had suspended them. And our banks are benefiting from the lower cost of capital that comes from that predictability of return even today, many years later. So stress testing, good in general. But there should be a predictable outcome. The practical side of the question to me for the SCB as well is that if it depends on what you have for breakfast, different people at different times have different breakfasts. And the potential consequences of the same stress testing outcome, depending on the particular people who have been appointed to the Federal Reserve at any point in the future, could be dramatically different. If you've left that open, you've essentially left it open to the vagaries of the political process if you don't have a concrete consequence for the outcome of the stress test. Over a long period of time, the Fed is a marvelously apolitical institution. As a citizen, I've been very, very pleased with my involvement with it to see how true that is. But, but the people are appointed through a political process, and over a period of time, you could have significantly different outcomes for the industry. So I think both for general legal principles of regulatory action should be subject to discipline, and the stress capital buffer makes it clear what that discipline is, and and predictability of results over time. That's how the outcome of the stress test should be implemented, is through some sort of a stress capital buffer.
Mike, you look like you have something you want to
Well, I
add.
just want to put an exclamation point for what Randy said. I mean, having had the stress test in April 2020 or spring of 2023, we felt confident, I think a lot of investors felt confident that banks could withstand whatever was coming their way, the largest banks.
If the agencies agree that the fundamental review of the trading book plus the GMS and the stress test hit bank trading books with excess aggregate capital requirements, what is the best path to reducing that surplus? Should we soften the GMS or look to soften the FRTB domestically or in Basel? Shira, you want to? I'm gonna volunteer you because you have the red light on your microphone.
I heard FRTB, and that's like magic to my ears, so I figured it was coming my way. My takeaway from Randy's talk as to relates to how the SCBs are derived is that I should have gone to culinary school instead of becoming an accountant. Would have been better for Goldman Sachs. But with that said, the FRTB, and for those that don't know, that stands for Fundamental Review of the Trading Book. That's the market risk component of Basel III Endgame. And the Global Market Shock, or GMS, which is included in the CCAR stress test, is the instantaneous shock to the trading businesses of the largest banks. And so your question underlies the issue at hand, which is that there's a duplication between how FRTB is shocking market risk and capital and requiring capitalizing for market risk versus the GMS. And if you dig even deeper, they both kind of do it in a similar-ish framework. They're both looking at the same position set, And they're looking at tail risk, so they're shocking it to like the very tails in terms of how those markets would be affected. And then, again, in the original proposal on Basel III Endgame, stacked those two things on top of each other. And so to your question, to the extent, as the Federal Reserve is looking to repropose Basel III Endgame, as well as, all the work that's being done on the CCAR process, I think both stand to benefit from a really deep dive to ensuring that the shocks and the assumptions and liquidity horizons that are being used in them are consistent. And I'll use an example that I think highlights it. The GMS still uses assumptions from the financial crisis in terms of the level of shocks, despite how far we are removed from the financial crisis, and more importantly, how much reform has happened since the financial crisis. So as an example, using securitized product, so this is the underwriting and packaging of mortgage-related or asset-backed or CLOs, taking all those assets together and issuing them as bonds. The shocks that the Federal Reserve applies in the most recent CCAR stress test, so the one that we just got the results of, are equal to the shocks that banks, that those assets suffered during the financial crisis. What that doesn't account for is the fact that the LTVs of those loans are significantly different. The FICO scores of the borrowers are significantly improved. And so the shocks are being applied to bonds and assets that are much better underwritten or subject to much better underwriting relative to the products that were being traded in the financial crisis. And so I do think that the GMS is very ripe for that, to get that overhaul, because it really hasn't been addressed, since it was first put in place. And one of the ways in which the calibration is off is to the extent that you take an asset, a securitized product, and subject it to both FRTB and the GMS. About 15% of the product that was underwritten last year, banks would be required to hold more capital than the carrying value of that asset. So I would have a bond with a carrying value of $100 million. And if I added FRTB and the GMS to it, I would capitalize that for $120 or $130. So the capital that I would hold is greater than the carrying value, such that if I wrote that bond down to zero, I'd actually release capital. And so it's an example of where you can look at it quite simply and see that the calibration is off. And as I mentioned, this isn't one or two bonds. This is 15% of the market that was underwritten last year.
So one of the arguments that Treasury Secretary Scott Bessent brought up last night was talking about whether or not firms should be able to opt in to Basel III Endgame, those that are not covered by it. And I guess I want to get the panel's view on, are there pros and cons to including them versus not allowing them to be included if they want to, and what the system looks like?
I'm a libertarian. And I'm nobody's mother. I mean, if they want to opt in, I don't see a downside, except potentially from the institution, and that's theirs to judge.
Phil?
Yeah, so this is a question about whether you apply the rules to small banks. So Basel 3.1 was agreed internationally, so it clearly applies to the largest banks. I've argued that it's better than what we have now, so I think you'd want to apply it to mid-sized banks for us. The question is, do you apply it to the very smallest banks? And so in the UK, we've long wanted to have a kind of a more proportionate regime for smaller banks. And now that we have left the EU and we can write our own rule book, we've been working on that. So we call it Strong and Simple. In homage to Mike. So we had to decide whether to take Pillar 1 from Basel 3.1 and give it to the very smallest banks. In the end, we decided we would because we just felt it was better. We felt it enabled them to compete more. The caveat was that where we saw that there were parts of the new Basel framework where they just didn't need the rules because they didn't do much of it, like trading book rules, CVA, counterparty credit risk, all of that kind of stuff, we said you don't do much of that. That's how you got into the strong and simple regime, and so you don't need to worry about those rules. So we carved them out of that, but the rest of it we did. So we have. I think it is possible to give the ratio, to give the Pillar 1 to smaller banks, and I do think they would benefit from it.
One of the things in my former life when I was editor at American Banker, we used to talk a lot about capital standards always inadvertently pushing banks out of different activities. So, can you talk about the extent to which there are dangers in Basel III Endgame of doing that versus, how can we morph capital requirements to bring some of the activities that were in the past possibly pushed out by these capital requirements back into the system?
I'm happy to start, and others can weigh in. I think that your question is 100% right, and we've seen it time and time again. No matter how big or how small the rule is, as the capital framework continues to evolve, you're able to pretty clearly see the impact of what it does to the broader market as a result. So when mortgage lending related requirements were gold-plated, you immediately thereafter saw an uptick in the amount of mortgages being underwritten outside of the banking system. Most recently in the implementation of SACR, which is the counterparty credit capitalization requirements, which is actually part of the Basel III Endgame, those rules changed the capitalization for short-dated derivative hedging. And as soon as that rule came into play, you started to see that activity move outside of the regulated banking system. And so that unintended consequence of the amount of activity kind of almost immediately responding. I mean, you even see it in CCAR shocks, where if in a particular year the Federal Reserve shocks are more punitive to something specific from an asset class perspective, you will see banks will do less of that, and it will move outside of the regulated banking system. And so that's something that needs to be really carefully thought about in conjunction with all the components of the capital framework that the Federal Reserve is looking at, whether it's the stress test or Basel III Endgame or GSIB, that to the extent that you're increasing the capital requirements on particular products for the most highly regulated banks, that activity will go somewhere, and it will go out to the less transparent outside of the banking system.
Randy?
Yeah, I do think that is something that has heretofore across a broad range of eras and people and regimes been given insufficient attention in thinking about bank regulation. Is that especially in the United States, but now really even very substantially globally, it's a financial system. It's not just a banking system. And if we adopt regulations that are going to push something out of the banking system, it will go elsewhere. We will not really constrain that activity. You have to think, and we will push it into either parts of the financial system that are less transparent and less well capitalized, or jurisdictions that are less transparent and within the banking system that are less transparent and less well capitalized. So, and there really has not been sufficient attention, I think, given to that holistic view. The growth of private credit in the first instance was really driven by regulation. I think it's now growing for reasons that are outside of regulation. I think actually there are reasons to think that the growth of private credit is probably stability enhancing because the vehicles through which private credit is provided are less subject to runs, and an ecosystem is developing where the banking system and the non-bank private credit system are working together in a way that allows more visibility from the bank regulators into the overall financial system. I think it's working well now, but there's the fact that it's working well, there's no particular reason to have driven it out of the banking system, and the bank regulators should think about You know, I mean, if a bank can do this lending safely, it should be allowed to do it safely, even though the private credit system is not, in fact, I think, harmful in any way.
Well, we have a brief few minutes before our panel ends, so I want, if there are, I have more than enough questions that I can keep going, but trust me, question right up here in the front.
Thanks. I want to take us back to some of Mike's slides in the beginning, where you painted sort of a picture of utopia, a city on the hill that would be both strong but simple. So if you were going to try and move us from where we are today towards both simplicity and strength, are there one or two things you'd say these would be the best moves to get to that city, both for Mike and for others?
Well, I call it balls and strikes. I don't set policy. So I'll let you know once I see it. But you know, when I talk about it being confusing, it's not just confusing to investors. I bet it's confusing to bank board of directors too, and bank execs, and frankly, probably some regulators. When I talk about it being constraining, you know, let's banks be banks. When I talk about it being costly, I mean, that's an easy one, and we all see examples of that. But I think, you know, two themes have come up, certainly holistic approach to capital. Second is the idea of level playing field. But I'd add a third one, and that would be dynamic regulation, because we're going to have more bank failures. There's going to be more bank crises. You know, that we all know that, but they don't repeat, right? You had lending to South American countries, and then you had commercial real estate, and then you had long-term capital, and then you had global financial crisis, and then you had Silicon Valley, and the next one's going to be different. So I like the idea of having examiners also being accountable in a decentralized way, as opposed to ivory tower academic setting models. So I think the degree of humility about what we can do, and when I was here 35 years ago, there was Bill Taylor, who headed bank supervision regulation. He was the best, and he was like, you know, be tough on the things that matter. That's capital, that's liquidity, that's what keeps you solvent. So that's my template for it, but I'll leave it to the ones who practice and do these things for the policy.
The good news is, you know, we're having a conference like this like we've never had before. And when you look at what Vice Chair Bowman's done over the course of the last few weeks, it's more change than we've kind of seen in both the recent past and even longer. You know, I think focusing your question particularly around the CCAR stress test, you know, we are pleased with what the Federal Reserve has done thus far in terms of enhancing some of the disclosure around the tests, and also talking about their willingness to put the scenarios and the models out for public comment, because we think that transparency is really important. As the firm with, I would argue, probably the most volatile stress capital buffer, I agree with Mike's points. You can imagine capital planning is very difficult when your requirements could change year over year by north of $10 billion, even though your business model is relatively consistent. And although the averaging NPR is meant to address that volatility, it doesn't actually address the fundamental or the root cause of the problem. The root cause of the problem is the scenario and shocks, which we've talked about, that really haven't been calibrated for all of the regulatory reform, the Volcker rule that we talked about in the last panel, mandatory margin and clearing, and all of this uplift that's been done to the regulatory environment, such that the shocks that existed in the financial crisis shouldn't be the shocks applied today. And then the models, again, we don't have full transparency around them, although we look forward to that, don't respect some of the observed correlations that exist that we've seen it happen time and time again. Example around trading revenues. All the most recent crises have proven that in times of volatility, trading revenues increase because there's more activity and bid-offer spreads widen. Nevertheless, when the Federal Reserve models trading revenues in stress, they don't include that assumption. And so I think that we're on a really great path, but that's some of the more particulars that need to get addressed.
Jarrett, over there.
Yeah, hi, Jarrett Seberg with TD Cowen. I'm going to regret saying this on camera, but I actually agree with Mike that I think most of the market doesn't understand bank capital rules. And I think we run into a problem where there's such a push for tailoring. We hear that over and over on Capitol Hill. But that means that we have even more sets of rules, and we don't quite know which banks apply, are covered by which sets of capital rules. I wanted to focus in particularly on available for sale securities and whether those unrealized gains and losses should run through capital. I was hoping the panel could talk a little bit about why that's only for the biggest banks, and should it be pushed down to all banks?
That's a good question. Does anyone want to jump in there first?
So it's, I probably shouldn't have pushed that button because it's been because it's been a few years since I engaged on the question. But it's harder than it sounds because to the extent that you push changes in the available for sale securities account through capital, then you create a strong incentive to move those securities to the hold-to-maturity account. And once they're put in the hold-to-maturity account, they are, as a practical matter, quite illiquid. So when the Federal Reserve, this was long before my time, this was under the St. Dan Tarullo's time, considered this question, that incentive was very important in saying, okay, well, we shouldn't do that for most banks in order to create this kind of incentive for structural illiquidity on what should be liquid securities. Of course, the problem is that those available securities do change in value, and that can have a capital effect. If you take, however, Silicon Valley Bank just as an example, where that was the most recent instance where this issue was considered, and people said, well, why shouldn't we have been requiring them to increase capital as the value of their securities was increasing? Actually, if you'd had such a rule, that would have created an incentive for them to push much more of their available for sale securities into the hold-to-maturity account, and it was the fact that they had all of these securities in the hold-to-maturity account that was concerning, because they couldn't liquidate those, and it was that overall position that was causing the concern about their overall solvency. So you actually would have worsened the Silicon Valley situation, most likely, by creating that incentive for them to put even more of their liquid securities into hold-to-maturity. So, how do you address that? Well, you could say, all right, well, for banks, we're going to require you to take the changes in value of both of those accounts into account for your capital. But a long time ago, the bank regulators decided, I think on balance correctly, that the regulatory accounting regime had diverged so much from the generally accepted accounting principle accounting regime that it was now that there were a lot of pathologies associated with that, and that the bank regulators would rely mostly on the on FASB standards for determining what what would be income, what would not be income. I think that's still correct. People have gone to FASB for a long time, even outside of the banking rules, to say that hold-to-maturity securities should be treated differently, and they have decided not to. Again, because it's not as simple a question as it sounds, and so until they do, I think that I think that that balance that's currently being struck about what to do with accumulated other income or what to do with the treatment of available for sale securities is two ways of saying the same thing is correct.
Well, unfortunately, we are at time, but I want to please join me in giving a round of applause to these panelists. Thank you so much for being here. Thanks again to the Fed.